Good morning, everyone. First of all, many thanks for joining today, and I'm delighted to welcome you for this very exciting webinar. This webinar is going to be, of course, practical to our sector, and we'll be happy to answer all your queries. I would request every one of you to post your queries as we go along because it's going to be a long session. So you may want to just keep the interest going. So you may want to put your queries in the chat box. So before we begin, I'll just begin with my introduction. So I am Rohit Chaturvedi. I am partner and I lead this transport and logistics vertical at Forvest Mazars. I have had almost 20 years of experience with Big Four, CRISIL, and so on. So my expertise include business consulting and technology. In fact, before we begin this session, I would like you to type in what you expect from this session. So it is, of course, for intermediate level, but we'll give some primers as well. But before we begin, if you can just type in what is the expectation from this session. I'll encourage everyone to write something at least. Okay. I think there's no expectation as of now. It is. Analyze the financial statement. Good. And creating a financial model. Yes. Okay. Ability to create financial model. Great. Any other expectation? Great. Understanding capex heavy sectors and how to create different schedules. So can you elaborate there? What is different schedules? Understanding financial modeling in the domain of transport and logistics, of course. This is the objective of this session. Clarity on key concept, forecasting, assumptions linking these statements. If I read it wrong or right, linking three statements. Okay. That is P&L, balance sheet, and cash flow. Okay. So those who have joined just now, I am just asking people to write down what is the expectation from this session. I think many of you attended the previous session, and this session is in continuation to that one, but we'll be covering all the basic concepts before we begin in this session as well. So what is the key expectation? Of course, budget, financial model in audit and finance. So audit may not be the forte. It is mostly going to be business view. Budget is, yes, budget is, I think it is going to serve as a basis for budget. Good. So another 2 minutes, I think, then I'll give you some flavor of what is expected to come in this session. So it's going to be, as I said, long session, and I will want everybody to be involved as we go along. Okay, another thing is that, what is your backgrounds? So that will help us in fine tuning our delivery of messages. So what is your background? Are you CAs? Are you MBAs? Are you economic graduates or graduate from any other stream? So can you just write it down? Okay, Sandesh CA, Mayank CA, MBA. Okay. MBA. Okay. Rishabh CA, MBA. Mm-hmm. Great. So I think, before we begin, I think I'll just leave it to Vivek and Aditya. But before we begin, I just wanted to set the tone for this session. Essentially, this session will have lots of common element from a general financial modeling exercise, but is going to be fine-tuned for one very specific logistics business, which is container ports. So I think you must be knowing that, and container ports are very specific kind of logistics facility. There are multiple type of logistics facility. We would not cover everything in this session, but I think going forward, we might cover each and everything in different sessions. But this particular session is about container port or container terminal rather, not port. Terminal, as we define, is a kind of subset of a port which handles specific kind of cargo. Why we have chosen container? Container, in fact, with this financial model, you will be able to assess not only container terminal, but you'll also be able to assess different kind of logistics facilities like ICD. So we have inland container depots, we have container freight stations. Nowadays, government has pushed for multimodal logistics park to reduce the logistics cost. So this particular model, which we are going to take you through, it is going to be a very detailed walkthrough. And essentially, if you require, the model can be shared with you all after the end of session. Uh, so this particular financial model can be used in similar environment across many logistics facility. The key highlight of this particular session is we are not really emphasizing on point estimates. So point estimates is very precise, as you know, that we give one IRR. So say IRR of 16% or IRR of 17%. Now, whether that is a good way or bad way to assess a business, that is questionable. So most of the people will want a kind of range of estimates, and the probabilities. And probabilities means if I know that I have a 60% chance of having 16% IRR or more, then my decision will be different. If I have 90% chance of my IRR to be less than 16%, then my decision will be less. So essentially, this particular financial modeling session will also speak about risk and how to assess this risk in more quantified way. So I think most of you would have covered risk in a very qualitative way. Here we are going to give a, a essence of risk in a very quantified way through Monte Carlo analysis. Now Carlo analysis sounds very fancy, sounds very difficult, but it's not as difficult as you might think. So first thing is, of course, you can do sensitivity analysis, but sensitivity analysis cannot give you that kind of flavor. It gives you kind of, again, different kind of estimates for different kind of inputs, not probabilistic inputs. So you won't be able to know whether I have this much probability, that much probability for the returns or for the outcomes of the project. So Monte Carlo analysis is one of the major elements. Though we are not going to cover all the inputs, we are going to take only two inputs, and we are going to see how probabilistic distribution of these inputs is going to change the output, and output in terms of probability distribution. So before I use this term probability distribution, what do you understand by probability? Can you type in? So 1 minute, everyone. What do you understand by probability? Okay. Mm-hmm. Yes, chances for event to occur. Shubham has the chances of occurring something. Great. Yes. So I think more or less everybody knows what probability is. And there are, the choices are going to made in terms of inputs. So here, the key element of Monte Carlo analysis is that we have to choose the right distribution for inputs. And sometimes we are not able to choose the right distribution because we don't have data. So what do? We use different kind of distributions and we find out what is the impact of each distribution. Probability distribution, I think you would have heard about normal distribution. You would have heard about uniform distribution. That means uniform, every likelihood is the probability of every outcome is equal. So when we are taking uniform likelihood, then we take that. Normal distribution is defined by mean and standard deviation, which is a very symmetrical kind of distribution. But I will not get into technicalities. Essentially, we are going to take some guess, and business is educated guess. It is not about very precise science. It's not very precise science. It is taking some educated guess and making better decisions based on the information available. So this financial model is not only because I think most of the people said we should be able to learn the financial modeling. That is a given. So once you go through this session, I think you will be knowing how to build financial model for container terminal. Apart from that, you will also be understanding how to see the risk and how to take decisions on the basis of those risks. So let me tell you one thing. We are advising one international player on container terminal side in the port of South India, and they did not envisage what will happen in the future. Of course, because they would not have done the probabilistic analysis. What had happened? They got that terminal way back in 1999, and then in 2016 or 17, another competitive terminal was opened by the port without giving the equal kind of infrastructure to the first port, which is international player. Now that has made the entire container terminal unviable. And why infrastructure is so dependent, in fact, on support, because it is not like manufacturing. Manufacturing, even if you see the ups and downs are very gradual or they're cyclical, at least you can understand. In ports, especially ports and logistics, if you have a competing facility which offers you something, uh, all the volume will go. So in one, kind of stroke, you will have say 100 revenue to 0 revenue. So that is the kind of variability that can affect your logistics project. So that is why this probability analysis is very important, and you might want to focus on that as well. And as I said, I think many of the people have joined just now, and but I would encourage everyone to ask questions. So it is a long session. If you lose a thread on any of the part, I think that will be difficult for you to catch up later. So my again, request is that you should be able to, put your queries as we go along. So yes or no. So maybe with that, I'll just leave it to Vivek and Aditya. They will introduce themselves and they will take you through this financial modeling webinar. And if you have any question, I'll be very happy to answer them. We'll have half an hour session at the end of this webinar where you can ask any question related to industry, related to financial model, and we'll be happy to answer all those questions. So Adit and Vivek, over to you. But before that, I will want everybody to be putting their queries as we go along. Yes or no? Great. Vivek, I think it is over to you, and it's all your session from here on.
Right. Okay. Good morning, everyone. My name is Aditya Mohan, and I work in the Jira team at Forest Bazaars. And with me today is Kashish Arora and Vivek sir, who has over 20 years of experience in finance and consulting. I'll just give you a quick run through the today's plan. And Firstly, we'll discuss why financial modeling is critical. We'll give you a refresher of the key financial metrics. Then we'll discuss about the anatomy of a financial model. Then we'll show you how to build a financial model in the Excel sheet and show Monte Carlo simulation in Excel. And also discuss valuation theory in infrastructure and end the session with the financial analysis of a public listed company. I think uh, Right. So every financial model, no matter how complex, it boils down to three stages. These three stages are the inputs, calculations, and the outputs. So the inputs, these are the assumptions like traffic volumes, tariffs, escalation indices, inflations, financing terms, capex, and opex. Then there are the calculations, which are the inputs they flow into revenues, EBITDA, and from which we calculate metrics like IRR, NPV, and DSCR across the project life cycle. Then we have the outputs. Now, these are the decision tools. So for lenders, DSCR trends, and for equity IRR. For sponsors, there are equity IRR and paybacks. And for regulators, there is viability gap funding or concession viability. So now that we've discussed this, I think we can move on to the financial model.
Adit, before we begin, I think everybody is aware about viability gap funding. Are we aware about viability gap funding? No, no, no. Okay, okay, great. I'll just give you a brief background on viability gap funding. So normally any project has to be financially attractive for private sector player. And when we talk about VGF, that is viability gap funding, it is essentially when we are going for project development through public-private partnership. So I think most of you would be aware that infrastructure projects in India, uh, in a majority of projects, now the governments are seeking private sector participation, which is called public-private partnership. But many of the projects, despite having public benefits, may not have financial returns. And those financial returns had to be made sure by the government. And that is made through VGF, viability gap funding, which is essentially upfront financing or the financing in lieu or in line with the investment by the private sector player. So say if the project requires 100 rupees for 16, this 100 rupees as a project cost, but is giving only 13% of return. Now, if government funds 20 rupees and private sector funds 80 rupees, then the return for private sector might go up to 16%, which is acceptable. 13% is not acceptable. 16% IRR is acceptable. So that 20 rupees is provided by the government or the sponsoring agency, which can be provided upfront, which can be provided in line with the equity investment by the private sector player, or it can be provided by the total capital deployed by the private sector player, whether it is equity or debt. So hope it is clear. If it is not, then we'll be happy to explain that further. Okay, fine, go ahead.
Great. So, good morning, everybody, and welcome to this session. We'll be talking about this how to create a financial model in a fair amount of detail. But before we proceed, I just want to check: is my screen visible and is the sound fine with you all, guys?
Yes, sir.
Yeah. Okay. So we just did a poll
So,
right?
Your screen is not visible.
Okay. I hope it is visible now. Aditya, can you confirm?
No, sir, it's not visible.
No, sir.
Now is it visible?
No, yes.
Okay.
No, it
Aditya,
is not.
can you just show the model from your side, the screen from your side?
Just yes, sir. Just give me a sec. Right. Can you see my screen?
Yeah.
Just 1 second. Give me 1 second.
And have the model open as well. Navigate.
Yes, sir.
Yeah, and the presentation.
Right. Yes, sir. Can you see the screen?
Yes. I'm not able to see. Okay. So when you're looking at, yeah. So we just did a poll where we talked about, we asked for your experience. And as for the poll, most of you are new to financial modeling. And when I say you financial modeling, perhaps you would have used it, but my understanding is that you may not have created it as such. Right. So assuming that most of you are new and maybe with little experience in financial modeling, we'll perhaps get into greater detail and explain the concepts at a much primary level. Some of you who are experienced may find it a little repetitive, but I hope you'll tolerate it for your colleagues on this presentation. So can we go to the next slide, please? So how do you build a model, right? What are the steps to building a model? The first step is basically, when you build a model, we think of financial modeling as primarily an Excel exercise, because that's where the prompt, that's where what everybody talks about. The moment you say financial modeling, Excel or some kind of a spreadsheet comes into mind. But more than Excel, what is required is an understanding of the business, right? Because what you're ultimately doing in the Excel is translating your understanding from the model, understanding of the business to the model, right? How, for instance, what are the operating expenses? what are the capital expenses, what are the revenue items, how does revenue item relate to the operating expenses. All these are part of what is the understanding the the business, and that gets translated into the Excel sheet. Now, in this particular case, we are talking about what is called as a project finance, which means there is a project, and that project has a certain start date. So at day 0 of the project, there is nothing there. Then the capital assets are built up, and then the operations start. So the next module, point number 2, Aditya. So the next, you start with the module which is called as a CAPEX module. What is a CAPEX module? Where you talk about capital expenditure incurred in the project, and along with that, you talk about the financing module, right? Which is how you finance a module. The next part in terms of building the financial model would be to build the next point, the revenue model, right? I think to the next point, please. Yeah. So the next module would be the revenue model. What is the revenue model? This is an earning based on the project. On what project? Which is what we have built in the first part. Getting on to the next part is the OPEX module. What is OPEX? OPEX is operating expenses, right? Expenses which you would, what is called as, which will go through the income statement or the P&L, profit and loss statement. It will not be capitalized, right? You will not have depreciation on these expenses as compared to the CAPEX expenses. So you build the OPEX module, right? And then you go on to building the financial statements, right? What are financial statements? You are aware about these 3 standard classic statements: P&L, also known as income statement, balance sheet, right? And then you have the cash flow statement, right? All of these are interrelated in one way or the other, and there is a standard relationship between them. Many of you would be aware about it. Then the next step would be to create the estimates of the returns. What are these returns and what type of returns? What are the KPIs, the measures we have? The typical measures you use in project finance is project IRR, equity IRR, DSCR, payback period, and other ratios, right? We'll talk about these in detail, but this is to give you an idea of what the roadmap for building the financial model would be. You start where? You start with the project, understanding the business, building the CAPEX, building the revenue, building the OPEX, consolidating your outputs in the standard financial statement formats, and then estimating the returns, right? So keep this roadmap in view, and this is how we will walk through the model in our case as well, right? So next slide, please. So yeah, so before we get into the nitty-gritties of how we are creating the model, let's also talk about the process, how you approach the process itself. So as one, we talked about understanding the business. Understand the big picture first before you get into the details. What are the big pictures first? So for instance, in this particular case, we are talking about a container model, right? What is a container terminal? What is a container terminal? It's a terminal at the port which allows for handling of containers, right? So basically, containers which come in different ships, right? What are called as typically container ships. These are unloaded, and then they're put in a certain stocking yard, and that's the process. You unload, put in a stocking yard, and then load it further for its destination. This is in the inward leg, and there would be an outward leg where the movement of the containers would happen from inland towards the ship. What does a container terminal do? It provides a service for handling the containers, transferring from one mode of transport to another mode of transport, right? So it's like a node for transferring of shipments. So once you have the big picture in view, it helps you understand what the elements are. Quite often when we look at financial modeling, and when you are asked to do a financial model, what typically happens is you invariably get to the complex part more and then get lost out. And this happens with everybody as as you're developing those models or business plans and so on. So the first idea is to get a big picture of the business understanding. Then develop a roadmap, as we talked about. A good approach would also be to talk about develop the model in a modular approach. What do you mean by modules? So if you have seen, how, say, for instance, even these electronic items are created, for instance, your laptops and so on, these are typically created, these are assemblies of sub-assembled parts, right? You have a camera, you have a power unit, a display unit, a processing unit, maybe a GPU or memory unit, and so on. These come in separate parts, and you are basically at the end of the day doing some kind of a plug and play, right? You plug one part into the other, and that's how you build the idea. What is the other way? Where you start building, integrating from the very small parts, right? And and then work upwards. A modular approach is what is adopted nowadays for a fairly long time in the in the manufacturing space, in other space, while developing your business model as well. So what are the modules we talked about? If you remember what we talked about in the earlier slide, we said there's a capex module, there's a financing module, there is a revenue module, there is an opex module, there's a depreciation module, there could be a tax module, there could be say a currency conversion kind of a module. If there are external funding, if there's refinancing, those modules will be there. So that's a modular approach. There's an iterative process. Remember, you are not going to get the financial model right first time. You go back, you go forward, and then you go back. So there is a looping which happens all the time, and finalizing your model typically takes some bit of a time. Right? You don't get it right the first time. So don't get hassled when you don't get it right the first time. It takes a certain time, and as you develop the model, you also develop the understanding in terms of how linkages could be there. A typical issue happens is when you're translating business logics to Excel logics, which are basically some kind of a mathematical or a logical function, if and sum if, plus minus, division, multiplication, those kind of logical operations which you're doing. You learn, and also it gives you option. So so these what are the most optimum choices to take? You develop by a certain amount of a trial and error. You do it, you check it, you see if it works or not. So it's not a, while it may seem like a linear process, but there's a lot of looping back which happens. Be ready for that. Your model has to be detailed and comprehensive, right? Which means detail means stuffing all required part. Getting into the nitty-gritties, getting into the granularities, that's important. And what is the level of detail which is required, which is as per the decision process, right? So if you're looking at, say, a granular level at, say, a monthly level or a quarterly level, then your model will need to be designed for or built for that purpose. If you're looking at a broader across the range 20-year span, then you're possibly looking at a annual level calculation. So those. A good point to remember at all times is a model is prone to error. One, there are errors which you will commit while doing it. These silly mistakes, wrong connections, etc. There would be errors in terms of understanding the business logic and translating into a calculation. And there would be certain errors which even Excel will be making. Okay, Excel at a certain level, while it's a very, very flexible tool, also brings in a certain level of assumptions, certain method of calculation. So if you have ever looked at Excel formula and spend some time on the help function, it defines how the calculations are done. So how the IRR is calculated, how the NPV is calculated, what are the rules it follows? You know, I mean, you would have heard about, say, the BODMAS rule, for instance. Now, does Excel follow that or not, or does it follow something else? There are, so for instance, if you are, you know, using models from European countries, possibly their method of calculations would be different from how you would do it. So, you know, the protocols are different. So sometimes you assume something, but Excel has a different assumption. So be aware about that, especially when you're working in a, you know, in a cross-border scenario. Okay, next part. So what are the things to remember? What are the good practices to have? One, keep your models dynamic. Okay, easy to navigate and read. And what is the ease of navigation? Ease of navigation is typically, you know, it means it's intuitive. So people who have kind of, you know, viewed financial model, viewed financial statements should understand the flow of the model and the logic of the model. Keep it detailed and at the same time provide big picture clarity, right? So you are saying, okay, every year there's a flow, but total flow is so much. So that's one way of doing it. Elegance, aesthetics is important, and this is something which you learn with over a period of time. You assume that, you know, we'll do the formatting at the end. Okay, that is a very dangerous approach to take, because by the end of your model, you will have possibly, you know, 5,000 lines of calculations, one way or the other, and then going back and redoing it is very difficult. So before getting into the model, think about these aspects, right? Then it needs to the model needs to be simple. At, you know, invariably there will be some level of complexity, right? But keep the complexity to the minimum. Reduce it as much as possible, right? Another practice to remember is keep it compatible across versions. A lot of people, for instance, use, say, an Office 365 version, and then there are, you know, other professional versions, and then there are, you know, Excel versions which are released by year. Why I'm saying this is because a lot of times when you're dealing with banks in India, say for instance public sector banks in India, their Excel versions may be a little dated, and sometimes the functions you use may not run there. So particularly when you're using an Office 365 version, which has a lot of new updates, they may not be available elsewhere. Keep that in mind, right? End of the process, do a detailed review at your end and get somebody else to also review the process, right? Okay, so let's go to the next one. Any questions so for as of now? Okay, let's go to the next thing. Okay, so what we are talking about are certain terms which we'll be using on a regular basis. Some of you may be already aware about it, but just so that we are on the same page, we'll talk about, right? So beginning with, what is the total project cost? Is total project cost equal to the sum of investment made in machinery, plant, civil structures, etc., etc., or is it more than that? Any idea? Can we have some replies here? The question is the sum of, is the total project cost equal to the sum of tangible assets, or is it more than that? Do we have replies? Yeah, so people are more than that. Includes borrowing cost for the particular. Payroll is not a cost item which would get into your total project cost, right? I mean, payroll, as in if you're talking about labor cost for capital expenditure, that's one part, but payroll for the operations, that's not there. intangible assets. Sometimes intangible assets could also be there. Like for instance, your intellectual property which you buy as part of the process, right? Because say for instance you're building a plant, or for instance you're building a certain asset. Even in logistics, for instance, the software is an intangible asset. Sometimes you may take consulting, say design SOPs. You may buy those from people who are from experienced players. So those intangible assets would also be there, right? So your total project cost is more than the tangible assets. By tangible assets, I meaning your civil structures, brick and mortar, your machinery, pieces of iron, steel, etc., etc. It's more than that. There could be intangible assets, and there could be expenses on preparation of the project as well. That there is cost of borrowings during the period of construction which is included, and there could be say even contingency. So contingency is item as we will see. So the broader idea to remember is project cost is not equal to just the pure capital expenditure. There's more than that. Next, please. What is the capital structure? What do we mean by capital structure? Right? You would have heard about this term. Many of you would be aware about it. What is the capital of a business? Capital of the business is the amount you put in upfront, right? And in what way you're putting in that amount? The funding side, you're saying debt and equity. So capital structure is a mix of debt and equity, right? So why is that important? Because in an asset, in a project finance, it's a very critical part. Okay. Then we talk about interest during construction. What is interest during construction? And what is construction? When we talk about construction phase in a project finance scenario, so in a project finance scenario, there is a period where you do the construction work. There is an interest or the borrowing cost which is incurred during that period. That is called as the interest during construction, and that gets added to the total project cost. So you will keep hearing in the context of a project finance, IDC, 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 IDC. This is something which has a great impact, and especially when things go wrong. Then capex phasing. What do you mean by capex phasing? Right? There is capex and there is capex phasing. Phasing means what? Basically aligning your capex with timelines. It does not happen at one point of time. It happens over a period of time, and that's what the capex is. Then let's look at some of the key measures. Right? There is something called as the IRR. What is an IRR? Interest on loan. Sorry. Is that an answer to an IRR? What is your understanding of IRR? Internal rate of return. Right? Why is it internal and not external? Because it's a rate implied in the cash flows. It's the rate at which the cash flows is getting discounted, right? It's a rate because it's a proportion or a percentage, and return, it's calculated on the free cash flows or the surplus which you are generating from the cash flows, right? So that's what the internal rate of return is. Now, what is the definition of internal rate of return? Yeah, somebody has said it properly. It's the discounting rate at which NPV becomes zero. So what is NPV then? NPV, there, if you break it up, it says net present value. Net present value of what? So there is a value. What is that value? That value is basically the cash flow. Present value means it is discounting to the present day. So people most would be aware about the time value of money, right? Money today is more valuable than money tomorrow. So there is a present value, you discount to the present factor, right? And there is a net. What is the netting happening? Total inflow minus total outflow. What is the inflow? Inflow coming from the project. That is the net income you are generating or the free cash flow you're generating. What is the outflow? Outflow is a capex which is going out, right? So that's a net value. Then you have the payback period. What is the payback period? Payback period is the amount, is a time period in which you recover the absolute amount of the investment, right? Does payback period consider the time value of money? Can we have your answers to that? What's your understanding? Is payback period considering time value of money? Yes or no? So in that, so a lot of you have answered yes, but that's that's not the right answer. Why is not the right answer? Payback period in the general sense is considered as a accounting measure, right? How do you calculate it? So whenever you have a question like you say, okay, what's the calculation? Your calculation is basically accumulation of the cash flows divided by the outflow. What is outflow? Capex. So total inflow post construction divided by the amount invested in the construction period. Where is the time value there? No. Is a discounting happening? No. So your payback period typically does not take into account the time value of money. Okay. So we'll see how it is happening in the particular model per se. But before that, we get into the Excel sheet as such. We are kind of focusing on how to deal and think about the model, right? So let's look at the basic structure of the financial model. So what is the first thing, as we talked about? The first, if you have to think of a model building with multiple building blocks, the first block is understanding the business and the project objectives, right? This is something which everybody, we have repeated a number of times. We've also emphasized that it is important. That becomes your basis for everything else. What is next? You provide the inputs, right? What are these inputs? These are your business and project assumptions. When are you starting? When is the construction? How long is the construction period? When does it end, etc., etc.? What is the revenue? What is the capacity? What is the cost incurred? What is the expected value? What is the operating the rate of expenses? How is it linked, etc., etc.? All of these are inputs, and we will talk about these in specific terms. Then, basis this input and the business logic, you create what is called as a projection. So you have capex. So somebody asked about schedules, talked about schedules, right? So this is where you create the individual schedules: capex schedule, financing schedule, debt schedule, interest schedule, revenue schedule, opex schedule, right? And within that there would be subcomponents as well: depreciation schedule, tax schedule, etc., etc. These are the separate modules which you're creating. Remember, we talked about modules at the start. This is where the modules. This is where you have these modules, right? Modules of different kind. And what do you do these with modules? Are these modules sufficient by themselves? No. So you consolidate them into. How do you consolidate them? You are basically putting them into financial statement. So your next step would be consolidating the output in the financial statements. What are the financial statements? Your P&L, cash flow, balance sheet, and you could do a ratio analysis as well. Is this sufficient? No. Right? It's required, but it's not sufficient, right? Necessary, but not complete. What do you require over and above that? You require some kind of a summarization, some kind of a scenario analysis. Why? So your next step is basically summarizing and doing your scenario analysis, right? And why do you need that? Ultimately, what is the objective of financial modeling? Can people reply? What is the objective of financial modeling? profit, estimate revenue, okay, valuable insights, okay, go ahead please, estimated returns, take business decisions. Yeah. Anything else? Future performance, check viability of project. Okay. Let's look at the next two answers. Any more ideas on how check viability of a project? So the way, in terms of defining the objective of the financial model, what are we talking about? We are saying to estimate profit, estimate revenue, get valuable insights, take business decision, future performance, know the projected value. So there's viability, estimation, and take business decisions. Okay. So let me just talk about these points individually. Do we estimate revenue? Do we estimate profit? Yes, we do. We estimate a lot of different things. CapEx, profit, OpEx, depreciation, tax, etc., etc. We do that. Yes. Is that the objective? No. Does it offer valuable insights? Yes. Right. Is valuable insight the objective of the financial model? No. It's an output, but it's not the objective. To take business decision, this answer comes in close, but a financial model will not take your business decision. What the financial model does, it is basically a decision-making tool, right? So it's a decision-making tool. So it gives you scenarios, it gives you options, it does the calculation for you, but it will not take the decision, right? So in today's context, for instance, when you are, say, for instance, referring to ChatGPT, you ask ChatGPT a question or some other AI a question and ask them to take decisions for you. Does it take decision for you? No. It is basically giving you options and giving a weighing of the options, right? Pros and cons, etc. The decision has to be yours, and therefore it's an important nuanced understanding here. How do you take your decision? How does a business take its decision? Needs to be incorporated in the financial modeling. So when we talk about understanding the business, also understand how the business takes its decision, right? So for instance, when you go to a traditional Indian company, their business decision is very different from, say, how a private equity with, say, a US headquartered private equity would take a decision, right? The parameters they would look at, the things they would be concerned with, the thresholds they would have would be different. Understanding that is important because ultimately you will need to tune your model to that aspect, right? Great. So we'll get into each of this one by one, but before we get into it, let me just explain what is the model which we are talking about. So the next slide, please. So this is the financial model assumes certain things, right? One, it assumes a certain thing about the business. What is this business about? This financial model is basically a project finance model, right? For what? A greenfield container terminal, right? It's not a brownfield. There is a brownfield component as well in this, and we'll talk about this when we can see the model. It's greenfield, which means starting from zero, right? What is the, like, there's a green field, and there is in the project context, do you know of another term which is used similarly? Like, what is an expansion called? A new project is called a green field. What is an expansion of a project called? What color of field? Yeah, brown field, right? So it's a brown field. So here we are talking about the green field, right? In this project, so which means it's starting from new, right? So from day zero, there is nothing there. Salient aspects: there's a long-term license, say 60 years or more, whatever we consider here we have done a 20-year projection. One could go further as well here. License fee is payable, which means container pays a license fee, so there is a certain cost here, right? And all the nautical operations, so all your port dues, pilotage charge, wharfage, etc., is collected by the port as it does not flow through this particular model. There's a two-phase construction. It's happening into so there are two parts separated by a few years, and revenue from core operations. Okay. Now let's go to the next slide, and what we'll do here is we'll talk about the slide and see the model as well. Okay. So yeah, so let's put this on the slide itself. So first is we are now talking about the inputs. Remember the building blocks which we talked about. Now we're getting into the details of the building blocks, right? Timelines. What are the timelines we talk about? Start date, key milestone, time scales. So Aditya, if you could just move to the Excel sheet. The Excel sheet, please. Alt tab Excel sheet. Yeah. Assumption. Put on the circularity. Assumptions, timelines. Go up. Yeah. So assumptions. The assumptions. Go up. Go up. Scroll up, please. So here we have the timelines, right? Now, what is the timelines about? So in the timeline, there's a start date, right? Start date for what? The construction period. Okay. Is this the start of revenue generation? No. Why? Because there's a construction period happening. Here it's assumed as 24 months, right? So it's 24 months of concession period. When does the concession period? When does the concession end? Start date plus 24 months. So if you see this is what we have used, the end of month function, right? So it assumes that the construction will end on a end of the month. It could possibly end intermediate as well. So then your function becomes different. What we have also done here, for instance, you'll see the FY, the financial year is being calculated. Why are we doing the financial year? Because we use this calculation elsewhere as well. So your assumption sheet, where you're building the assumption sheet, it's not just standard inputs, listed down in a list. You prepare it in a certain format. Why? Because then you can take the inputs and use it elsewhere in a more standardized fashion. So this is the phase one. Then there is a phase two. We talked about the project having two phases, right? What is the gap between the first phase and second phase? 3 years, right? This could vary. Then you have this, because it's an expansion, there would be no asset for the phase two. You have to build it, so there will be a start date. Similarly, there will be a construction period, and then there will be a commercial operation date. What's called as a, so in the typical project finance jargon, there's something called as a COD, commercial operation date. This is something you see typically in the PPP context. The concession agreements would typically mention a date as a term called as COD, right? It's COD, and there are versions to it. It's called SCOD, which is scheduled commercial operation date. There is a, there could be a partial COD, which means part of the operations could be commercialized. There could be a delayed or the revised COD. In generally, in a private context, COD is not as much used as a commercialization date or date of start of operations. So the terminology would be different, but the idea, I hope you're getting that. So then you convert it, and then we develop a time scale, right? So you see timelines, you see COD year, phase two, phase one, right? You can see my cursor moving, and that will give you an indicator of where I'm pointing out. And then we define the year. So there is financial year, start of the year, there is end of the year, right? Going to the next year. So it's a simple calculation. Start date defined from where the input, the start of the construction, and then so on. You calculate the days of operation, which is basically this. So here we use an if function. So to do financial modeling, you need to be comfortable with the if function and also the nested if function. What is a nested if function? It's basically an if statement within an if statement, right? So if statement is basically if this is true, then do something else, right? That's the if statement in general. Here you have nested if is basically you have if within the if. So for instance, if you see here, when we are calculating, marking out the COD year, what we are doing, if this particular date is equal to which date is equal, if this particular year is equal to the COD year, then say phase 1 COD, else check if it is equal to the phase 2 COD, else leave it blank, right? So that's the logic we are using. And this is a scale which we'll be using across. What is the advantage of this scale? Remember, we talked about, elegance, aesthetics, simplicity, etc. So you're doing a calculation of timelines at one place and not doing it repeatedly. And therefore also avoiding mistake, keeping it clean, neat, and avoiding mistake as well. Okay, so let's get to the next step, right? So in the the PowerPoint, the slide, just tap to the. You can use an alt tab. So next is the capex assumption. Right? What is the capex assumption? What are the capex assumptions talk about? Where are you spending? So these are the capex items. What are you spending on these items? So these are the capex costs. Financing costs, we talked about, IDC, borrowings, etc., and capex scheduling or phasing, right? Financing costs, remember there is something called as IDC, which we talked about. There could be other financing costs as well. For instance, what? Can somebody give an answer to that? Okay. Other than the IDC, what else could be the financing costs items in a project finance situation? Any guesses? So there could be charges like, say, your bank guarantee fees. Okay, a lot of time guarantees have to be given, or else or other non-funding financing has to be taken. You might, for instance, take, say, hedge against say hedge on foreign currency if you're importing equipment. So all of these are costs which are capitalized, right? So these add up to the in the cost. These could be linked to the total cost. These could be standard. There may be a certain percentage as well. So these financing costs would also need to be included. Okay. And then there is capex schedule. So let's look at the how it appears in the Excel sheet. Aditya, to the Excel sheet, please. Assumptions, row 25. Yeah. So I think if you could just enlarge it a bit, zoom in. Some people are just increase the size. Yeah. Okay. So what are we seeing here? Capex items, right? One, you see there are two phases, right? So for different phases, different calculations are being done. So you're seeing items, cost of items, right? The required area per unit, number of cranes required, total civil, the terminal berth, the length of the terminal berth, and the cost per meter, which is say 1 crore here, number of cranes, other equipments, and the cost per equipment, right? And then you do the total calculation. Then there is IT system. Is the screen visible? Is it fine? Do you want screen to be enlarged a little more? Can you zoom a little more, Aditya? Just increase from the Zoom. So go down, go down. You're in the phasing. Yeah, go down. Yes, yes, yes. So, yeah, just थोड़ा सा ऊपर आ जाओ. Just keep scroll up a little on the capex assumption, right? Capex estimates. Yeah. So on the assumption sheet, please. Yeah. So this is how you're calculating. Just zoom in a little. I think this it is spilling out of the screen. So broadly, how you're calculating that? You are saying items, number of items, cost per item, and then total per item, and then totaling it all together. Adding other than tangible assets, IT system costs. Some of these IT system costs would be, say, for instance, in software or maybe in some IP as well. For instance, you know, those processing and those. Then there are preliminary expenses. What are preliminary expenses? So before starting a project, there's a lot of investment which needs to be made, right? Expenses which need to be incurred. Okay, even like spending the management time, right? Doing ground surveys, doing general surveys to understand market surveys and so on. These are expenses which you need to incur before understanding whether the project is feasible or not, whether it makes sense or not, and how to size and structure the project. So these are typically included in the preliminary expenses. The interesting part is the preliminary expenses may not be incurred necessarily from the starting date. The preliminary expenses may have been incurred earlier than the start date, which is mentioned here, but you take it here. Okay. So a lot of these preliminary expenses could be things of that sort. Then you have engineering, consultancy, fees, etc. Furniture, fixtures, basically when you create an office, etc. So and so on. And then you add it up. I think you will have to just so here, if you look at it, I hope the screen is visible to all. R&D cost, you would typically not include here. See, when you're doing a project, you would not do an R&D. You would want to be sure of what you're putting in, right? Because R&D carries a risk. A project cannot take that risk. R&D cost is a later on cost if you're doing any R&D typically. In a project, you would go with technologies which are known and tested, time-tested technologies. Some innovation, yes, but largely time-tested technology. So no R&D expenses as in this particular item, right? Now you add it up. So here, for instance, if you see the total cost adds up to 735 crores, right? Then there is a contingency. What is a contingency and why do we need to have a contingency? All of these assumptions put together, you have done a lot of study, analysis, etc. But is there a chance of going wrong? Yes. Nobody is perfect. All estimates are estimates at the end of the day. The reality will not listen to your estimates. It will come as it is. And therefore, you plan in a contingency. This is a buffer, right? Here, we have not taken the IDC because we are calculating the IDC separately. Okay. Now, let's look at the phasing. We have put the phasing in CAPEX sheet. So, Aditya, if you could go to the CAPEX phasing, which is CAPEX row 51. Yeah. So, this is the CAPEX phasing. Now, what is meant by CAPEX phasing? So, if you see, we are spending 300 crores on civil construction, but do you spend 300 crores at one go? No, right? You spend it elsewhere. Aditya, if you could remove your cursor, please. I think that is getting blocked. So, if you see, you're spending 10 crores, 10% in the first quarter, 20% in the second quarter, 50% in the third quarter, right? Similarly, for cranes, you're spending 20% in the first quarter, in the third quarter, and then 10% subsequently, and a higher percentage at a later date. Okay, and so on. So this is called as phasing or the implementation plan, right? And why is it important, right? It's important because one, it has to align with the spending because you will be drawing funds on it. And remember, every penny you draw, every paisa and rupee you draw on the project is a cost. Okay, so give me a quick answer here. is there a cost to equity? If I'm doing a project, I am putting in my own money in the form of equity. Is there a cost? When I take a loan, I have to pay an interest. When I have to take an equity, I don't need to pay a cost. So where is the cost coming in? What is the cost of equity? I'm not paying anything, right? Why is there a cost of equity? Yeah, opportunity cost. Also, any capital will come with a certain cost. You are drawing that equity from somewhere else, right? So one, it could be deployed somewhere else, but whenever you're raising that capital itself, it comes at a certain cost. Opportunity cost is one way of measuring what the cap cost could be. It could also be the expectation. Suppose it's your ancestral wealth, and you don't have to pay anybody anything from that whole chest of you have got from your ancestors, but still you would have an expectation, and that expectation cost also comes in, right? Expected return. So that's in cost. Why are we saying there's a cost? Nobody anywhere else other than, say, for instance, in charity, maybe gives money for free. So money always comes with a cost, right? So that's the scenario, which is why we take the cost as well, right? So capex phasing happens there. Where do you get this data? Where does the capex phasing data comes from? Yes. Can we have answers to that? I'll be moving a little bit faster from here, but so capex phasing data basically comes from your engineering plan, right? Your technical consultant would give you, but it's also optimized for your financing requirement, your management concerns, etc., etc. So it's not a final. It's not just technical plan. It's more than that. You add something for it. It's optimized. Okay. So we talked about what? We talked about capex items, capex input, etc. Can we go back to assumption sheet, please, Aditya? Capex estimate, row number 25. Okay. Now here, if you see in capex phasing, you'll have to scroll down a little bit. Capex phase 2, the costs are different. There's something called as an escalation in capex. Why is it there, right? Because the time period for the two is different, the cost would be different. And why would the cost be different? Because there would be some inflation in between, right? And that has to be factored in. Here we are assuming 5% inflation, right? Going back to the slide, the next one is the financing assumption. So Aditya, you can possibly stay here on this. I'll just talk about the financing assumption. So what are the financing assumptions you have? You have capital structure, which is the debt to equity. You have the cost of capital. You have drawdown terms. You have repayment terms. So let's look at how we present it in the model. Can you scroll down a bit, please? Let's go to key financing assumptions, right? So what do we have? We know what is the total project cost. This is an iterative thing, including the IDC. Remember, we'll just see how we are calculating it, but assume that this is the number. We say percentages. So all your equity, equity is basically a percentage of the total project cost. Your debt is a percentage of certain or total project cost, right? Your internal accruals, there's no internal accruals initially, so you don't have a no internal accruals initially, right? What are the terms of debt? Terms of debt, whenever a banker is giving you, it can put terms on your equity as well. It says, for instance, upfront equity of 25% before we put in the first paisa of debt, right? When it comes to moratorium, it says, so during the construction period, no repayment is happening. Post-construction period, post the COD, start of commercialization, there's a 12-month of moratorium, which means moratorium on what? No principal is payable during this period, but interest is payable. At all times, interest is payable, right? So tell me one thing. Yeah, so there is a poll. Can we have? Yeah. So I'm just looking at the poll answers. in terms of the capex, sorry, the escalation rate for capex. A lot of people have answered consumer price index, right? And the second most is WPI, right? Why is consumer price index right or wrong? So if you look at what a consumer price index per se is, consumer price index is based on the price a consumer pays, right? Will a project be paying consumer prices mostly? No. Why? Because it is paying wholesale rates. The amount it is buying will be in bulk, right? So, like for instance, this particular project we're talking about is say about 1,000 crore project. When you are buying 1,000 crore of assets, you would be buying at wholesale rate. So your wholesale rate is something which is more applicable here. Therefore, in project finance, we typically link it to the wholesale price index. It may so happen that when you are doing your escalation on the revenue side, you link it to the CPI, because that may be the term on which the concession or the policy allows for. So those challenges, those things could be there, right? The rupee dollar index, obviously, you would, unless all of it is in, say, you are buying it in foreign currency, unless that is the case, you would not use the rupee dollar index. Okay, so going back to the financing assumption, so 25% upfront capex, moratorium, and then there's a repayment term, right? And then how does the repayment happen? So if you look at the repayment schedule, so this is the repayment schedule, assumed here. Will it be right repayment schedule? No, not really. It could be varying, right? So this is an input which is there, right? Then you have starting date, end date, etc. Right? Going on to the next part of the assumption, the revenue assumptions, right? So let's look at the revenue assumptions. Can you go down? So operation assumptions within post concession will happen. So you have assuming that what is the capacity, what is the capacity utilization to decide the value, the split of the traffic, the the charges, the escalation rate on the charges, the revenue line item 2, and the escalation rate on the revenue line, right? Going down further, then you have OPEX assumption. So what are the items which are incurred? The basis, like power will be incurred, say, on a per TU. What is a TU? One container, 120-foot container is called 20-foot equivalent unit is considered as a standard. So per 20-foot unit container, you are spending so much units of power or so much unit of fuel, and your maintenance, etc., maybe on the gross fixed asset. Can there be a different basis to these assumptions? Yes. Where do you get these bases? You get it basically, I mean, there are certain norms for the industry as well, and you could get it also from your technical studies. Then there is one assumption with respect to the working capital, which is trading receivables, trading days, right? Now, let's go to the CAPEX part. So, yeah. So now what we are doing, once we have the input in place, we will be doing the projections, right? What are the projections we do? So first would be the CAPEX module. So let's go to the CAPEX module. Okay, so when we look at the CAPEX module, here, okay, now there is one setting which you'll have to do in Excel. Okay, and let me show you the setting. So go to File, go to Options. Aditi, you'll also have to do it in the sheet. Go to Formulas and go to File, first File. Go to File, Options. Are you on the file? No, you're not on the file. General Formulas, Click on the formulas, and there's something called as iterative calculations there, right? So click on the iterative calculation. Click on the iterative calculation, right? And click OK. Now, see, you're seeing the setting there, right? Now, what have you done? What have you done by clicking on the iterative calculations? See, when we are doing this calculation, remember there's a term which we use called iterative process initially when we're talking about the introduction to financial modeling. IRR calculation is not definitive. IDC calculation is not definitive. What you're doing is you are saying A plus B plus C is equal to C. Right? Now, if you do that calculation, you cannot do that calculation unless you do an iteration. So every time you change C, your total will also change. Right? So to allow for that, you allow the iterations to happen. All your your project finance situations models will require iterative calculations to be on. If you don't put it on, the model will show an error, right? So how many of you were aware about the given command becomes 0? Is Shubham, are you talking about the IRR? So the formula, the idea which we have used here is basically used for macros. When you're doing a macro, this particular model does not use a macro. In iterations, it will not become 0, but close to 0. Right? So your answer, so whenever you make changes, whenever you redo the calculation, you'll see the numbers will change slightly, or you'll get a sense of the Excel doing certain recalculations. Okay. There's another trick which you need to know. Some of you may be aware about this. So sometimes your model becomes very big and complex. So you reduce the complexity. How you do the and slow. So how do you improve on that? You basically go to formulas, and there's a calculation option there, right? In the calculation option, you'll see automatic, partial, manual. What you do is, if there is, it's speeding up, like it's getting too slow, you click on partial or manual. When you do partial, your data tables are not getting updated. When you do manual, it will update only when you click F9. Okay. So having done the setup, let's go to the CAPEX. We have talked about the timesheet. Aditya, please scroll up. Yeah. So timelines is something which we have talked about. Up right at the top. Right to the top, row 3. Yeah. So this is the timelines which we have talked about. We just copied it here for ease. CAPEX estimates we have talked about here. Okay, scroll down. CAPEX estimates is something we have taken from the assumptions. We have put it here for ease. If you see towards the right, there's something called as a sensitivity which is built in, right? So between the assumptions and this, what we are doing is we are adding up the sensitivity. Okay, which is basically, if you see the formula, can you click on the formula? Yeah, if you say click on 60, row is 32, you'll see there is at the end we are saying 1 plus M31, right? Which is the sensitivity being taken into account. Okay, so CAPEX estimate we have calculated, time size we have calculated, phasing is an input value. What do we do next? Let's scroll down. We translate the phasing percentages into the absolute numbers. So if you see from row 57 to row 70 is the input values. From row 73 to row 80 is the absolute values. I just want to scroll down, please. Yeah, so this is the absolute value of the quarterly phasing, right? There's an IDC also, and I'll show you where the IDC is coming from. So if you click on IDC, you'll see the formula. Aditya, if you could click on cell F89, you'll see the formula. Capex is equal to Capex is Capex fund E74. What is Capex fund E74? Let's look at it. Capex fund next sheet E74 is the IDC calculation. So we are calculating it here and taking it back to the Capex. So let's go back to Excel sheet row 89. Yeah, Capex row 89, right? So your IDC is getting calculated back. Next, what we do, we summarize it in an annual on an annual basis, right? Earlier it was on quarterly basis, now it is an annual basis. Can you do a more different kind of calculation? Yes, you can be more elaborate in terms of phasing. You can do a monthly phasing. You can also incorporate escalations in between. You know, sometimes projects last for 3 years, 4 years, 5 years. Now, in those situations, your earlier estimates of cost may not apply, and therefore you may need to apply inflation adjustment in those projects. For instance, you know, if you see chances of project getting delayed, then also possibly you need to apply inflation adjustments, right? And you can add extra level of granularity in it, right? And so on and so forth. So this is what we have done in Capex so far is calculated the, you know, based on the inputs of timelines, total cost and phasing, we have calculated what would be incurred every quarter, right? So if you go down to say row 101, you see on an annual, if you compare say row 90 and row 101, you're saying total Capex, total capital cost phase 1. So you're incurring 47 crores in the first quarter, 66 crores in the second quarter, 203 in the next, 135, 55, 56, so on and so forth, which means a total of 452 in FY27 and 366 in FY28, totaling to 819. This includes the IDC, this includes contingency, this includes all the other items. Okay. So how are we clear so far? What is the kind of conclusion you have till now? Can we address any of the queries right away? Any queries so far? Okay. So if you have queries, you can start putting in the chat. We'll answer to that as well. And okay, so now we have a few questions on Capex funding, right? Aditya, do we have, can we put in the poll here or should I ask directly? Okay, which is correct about IDC? IDC is a non-cash expense. IDC is not payable. IDC is payable. None of the above. Can we have more answers? So IDC is payable and capitalized, right? So for others who have not answered on IDC, are you clear on that? IDC is a non-cash expense. That's a wrong statement or a right statement? IDC is payable. You pay IDC, the bank will charge you. There will be a cash outflow from your escrow account for IDC, interest during construction. So it is payable, right? But it is capitalized. What does capitalization mean? It means that will be added to your fixed assets, and therefore it will get straight into your balance sheet and will not pass through your P&L statement. Right? IDC will not show in P&L statement. Right? So in the model, how have we managed that? So if you see, when we are calculating the IDC, let's just see how we are doing the funding per se. Okay, let's go to the capex per se. Now, capex fund, right? Can we switch to the next sheet? Your next module is the capex funding module, right? Because it's a large amount, which and there's no internal accrual for the in the project itself. You need to borrow money, right? One source of money is your equity, the other is debt. Often there is this one terminology. Can you just scroll up right to the big top? So internal accruals, this is also sometimes called as the means of finance. This capital expenditure and means of finance for capital expenditure, right? So equity, as you talk about, is the money which the promoters will be bringing in. Debt is what is the borrowing. Since the start of the project, there is no internal accruals, that is zero. Okay, we have right. So we'll talk about the answers to the whole questions as such. You can keep answering it in the meantime. So in the phase one, there is no internal accruals, so that is zero. In phase two, there is internal accruals. Therefore, we have some amount coming from that as well. And you see equity is less. The overall ratio is still 70-30. 70 of debt, 30 of equity or internal accruals. Right? What are the terms? We saw the terms. What is the repayment schedule? This is the input value just being repeated here. Then what are we doing? Let's go down to drawdown. Right? Row 30. What are we doing here? We are calculating what is the drawdown, what is the fund requirement, and we are matching the capital expenditure with the fund requirement. Now, how do we do that? One is to look at, see, it is periodic, so we are doing it quarterly. Drawdown is quarterly, right? Then there is a priority, because your terms of debt says upfront 25% equity has to come in. So upfront equity is coming in. Then your balance equity is coming in. And how is that happening? How is that calculation happening? So first you say, in the first quarter, you are spending 47 crores, right? 47.25 crores. What is the overall upfront equity amount? 61.45. Why is it 61.45? Because it's 25% of the total equity. Now, is 61.45 less than or more than 47? It's more than 47. So you are basically taking 47 out of that. And then whatever is remaining, you are taking 14 of that. So total upfront equity, 61 crores totally drawn out, right? No more money is left in that account or that pocket. Next, what is the balance? Then you calculate the balance. Balance post upfront equity, right? Now, how are you funding that balance? Remember, we talked about the debt equity ratio of 70-30, but basically we are splitting the funding into three parts: upfront equity, balance equity, debt. Right? Therefore, the ratios will change. Right? So instead, your ratio between balance equity and debt will now become 74-36. The simple calculation says, whatever is remaining post debt equity minus the balance equity, right? The balance equity by funding beyond the residual fund requirement. So then you do the equity drawdown, then you do the debt drawdown. That is a pro rata payment, right? You are summarizing it for ease of study, ease of reading it, and then you are summarizing it further downwards. Just scroll down to on an annual basis, right? Just up. Just keep this section visible. Yeah. So you have this. So now in FY27 you are drawing down 156 crores of equity. Remember, the total phase one cost is 819. We are doing this for phase 1. We'll do it separately for phase 2. Phase 1 cost of the total 819 crores. Adit, please remove your cursor. Yeah, 819 crores. We are funding 156 crores of equity in the first year, 296 of debt, right? Coming to 452 in FY27. In FY28, we are doing 89, 277, and total of 366. If you see, this matches the above, right? There's something else which is happening, right? We talked about checks in place. So other than if you could just click on cell A51, right? There's checks in place. What it says basically is your equity drawdown is equal to the total amount you have anticipated. Click OK or leave it blank, else point it out as a check. So for instance, let's suppose, I keep this amount, say for instance here as 0, right? Is it doing a calculation? I'm not changing the model, it might just change the numbers a bit. So if you remove, or if there's an error here, it will show a check here. So while it is not stopping you from going further, it is visually indicating that it's different, right? So for instance, now let me just show you how it is, how it may work. So say for instance, instead of D, I'm using it as E, right? So a check comes in, right? So visually, you know that there is an error, right? Now, once we have the drawdown of the fund, there is a cost to the fund, right? And you're looking at due and payable cost here, right? Due and payable cost. All of this is before COD, right? Till COD funding. Let's scroll down to debt and interest schedule phase 1. Okay, what are we doing? So we know the opening. So debt, where is due and payable happens only with the debt, right? There's no due and payable in the equity right now in the concession period. Opening balance 0. What are you adding? This is what you're adding on a quarterly basis, which is similar to what you have added elsewhere. So 573 crores of debt. 573 crores of debt in total is drawn down, and then there is interest on that. In the interest, you're saying you're taking it on a quarterly basis. So you do interest, total interest per annum divided by 4, right? And then you do the IDC. This value gets into the where your total project cost as well. This IDC for phase 1, right? You're summarizing the phase 1 on an annual basis. Why do we summarize? Because it becomes easier to manage. Else, otherwise, if you're not summarized it here itself, you'll have to do summarization in every input, that every calculation that where you're using this as an input. Next, we go to the interest post construction. So you have a marker, right? What is a marker here? That calculation is due because operations have started. So if you see in row 89 here, days of operation. So there's a 365 days here. It means operation is happening. There's a partial date. We calculate it partially, right? And then there's an interest. So interest is calculated for the days in the year or parts thereof, right? As terminology would say. And there would be repayment. Where is the repayment coming from? The repayment schedule which you have provided. So what have we done so far? We have put in the input values in the assumption sheet. Then we have calculated the total capital expenditure on a quarterly basis for phase 1 and phase 2. Also provided for sensitivity calculations while inputting our formulas. And then we have done capex funding, right? For how the funding would happen. And we've also calculated the interest due and payable and the interest schedule post COD as well. We do it for phase 1, and then same process we do it for phase 2. You can copy paste the formula, but remember the referencing will change. So whenever you are copy pasting in Excel from one page to the other, please take care of the referencing. Okay, that's where a lot of errors happen. Okay, so do we have questions? Let's look at the questions. The polls you have answered to. So IDC we have answered, which is the poll. Which of this is correct? Project should not take debt at all. Reasonable estimate should determine level of debt. Banks may fund 100%. Okay, so all of you know are good with understanding. What is the level of debt? It should be reasonable. What is reasonable? That will your model will can show that, right? Is there a norm to being reasonable? Yes. 70-30, 80-20, 60-40, maybe very high risk project 50-50. If you're doing, say, a very innovative project, right, where you're not sure of the outcomes, one, it will not be typically project finance, and there would be hardly any equity in it. So you say your startups don't get project finance funding, right? Okay, let's go to the next answer. What is the impact of delay in construction on IDC? So impact on IDC may change significantly, depends on project to project. Bank may not charge interest. So you are, yes, smart guys here. May change significantly, yes. Will it depend on project to project as well? Yes. Why will it depend on project to project? See, if your drawdowns are towards later stage, right, it's back-ended, then versus a project where it's front-ended, there would be an impact. So if you draw down your funds later, by fund I mean debt fund, your impact would be lower, right? It's proportionate to that. So both these statements are correct. Will the bank charge interest for project delays? Yes. It will charge penalties as well. Okay, there's something which you have not incorporated, which may be also considered if you are considering it. We have taken an optimistic outlook, and therefore you're not charged, but that's something which you need to consider. So if you're preparing a model for the bank, you'll need to incorporate those, right? Banks typically call them as liquidated damages in case of conditions not being complied with. Next question, which of these is correct about cost of equity? It is standard for all projects. Depends on bank's decision, determined by consultants, depends on risk and benchmark rates, right? Is it standard for all projects? Does equity have a standard cost? So any answers to that? Why can somebody explain, whoever has answered this, of a standard cost for equity? There is a good logic to that actually, right? Money is money. Whether I'm putting a money in project A or project B or project C, I want a good return, right? But when we talked about cost of equity, there's something we talked about. Is one, it's the opportunity cost, it's also the expected returns, right? So let's take an analogy. You have money. Let's suppose you have, say, a 1 lakh rupee and you're putting in an FD, right? You could put it in SBI, you could put in a private bank, you could put in a small private bank, you could put in a cooperative bank, right? You are putting the same, you could put in the same money basically everywhere, right? In any of these options. The money is the same, but the expectation changes, right? In SBI, say Bank of India, you'll say, the risk is lowest. There's some kind of a sovereign guarantee to it, right? So you'll say, no, I mean, the risk is lower versus a cooperative bank, the risk is higher. So what changes is your expectation basis your analysis of the project. Project also has an inherent risk, and you're reading that risk and making an assessment. Therefore, your expectations changes, and therefore you're not looking at all investments as standard investments. You're segregating. So which is why it depends on the risk and the benchmarks, right? Okay, do we have any more questions here on the poll? Great. Any queries so far? Is it interesting, boring, too cumbersome, too difficult? Great. Thank you, Shubham. Anybody else? For anybody, is it like getting a little bit too complex? We need to inform, simplify things a bit, clarify certain points. Okay, so now what we have covered is the capex funding so far, right? What is the next part we do? So in the module, we have talked about capex module, finance module. What is the next module typically? You say revenue module. What will we cover in revenue module, right? Can we have can we just look at the PPT, please? Slide 8. Yeah. Next one. No, this is the next input slide. Let's go to the next slide, please. Next slide. Just enter. Enter. Yeah. Next. So capex we have covered, financing we have covered. Revenue. What do we cover in revenue? Revenue, a module basically is the estimation, is the estimate schedule for the revenues over the period of years, right? What are the things we do here? We calculate. I mean, you could break the revenue model into, say, the traffic volume, or the volume module and the revenue model. We have taken it together here. So one you do volume, which is the traffic. In logistics project, this is a term you'll come across a whole lot. Whenever we are saying traffic, we basically mean volume. We mean, what is the traffic of shipment, traffic of cargo, traffic of people, traffic of vehicles, with respect to project type of project. So that varies, but traffic is basically that term. Traffic volume over the time, split into categories. So your traffic may be considered as one single block or may be broken up. Here, for instance, we have talked about EXIM cargo, which is export-import shipments, and coastal cargo. Why are these two different? Because their nature is different. The tariff you're charging is different. So that's why. Revenue rate, right? That changes. So what is the rate of revenue? That was the charges you're applying, and that changes over time. It changes by what? It changes by escalation factor, and then you do a revenue projection by category. So going back to the Excel sheet, let's see how it's happening in this particular model. So Aditya, revenue sheet, row 7. Go up, right to the top. Yes. I hope this is visible. So we are talking about volume sheet, right? So the first thing we are doing is, how are we calculating the volumes? There are various approaches to calculating the volume. You could have estimates for the volume, the exact number from the study itself. So it's say volume of say a lakh TEUs, 1 lakh containers. TEUs is 20 feet containers, right? So you can have an estimate of that. How we are doing it here, we are basically saying total capacity, which is, say, 0.6 million or 6 lakh TEUs per year for phase 1, and a similar capacity for phase 2. And we are taking the capacity utilization. So capacity utilization is a number which has been taken. If you see the number here, we are starting with 25%, going to 40, 55, 70, and capping it at 90, right? Why lower earlier and higher later? Because it takes time to establish in the market, and therefore you have a lower number here. Is 25 the right number? Is 25 the exact number? Is 25 going to be what will happen? No, it may be different, right? Will it be in the same range? If our study is right, yes, it will be in the same range, right? Is the logic correct? The logic of taking a lower number earlier and then a ramp up to a higher number, that's correct. Why is it correct? Because that's how it happens in reality, right? So we're trying to picture reality, you are trying to simulate reality. Will it happen differently? Yeah, probably, right? So now there was this one interesting case which Rohit had mentioned initially, where a particular terminal operation, it started well and then it fell off because the competition came in, right? Now, so we are assuming 90% stable all around. That may not happen. Now, how do we, take that into account? We basically build as a separate scenario. Right now, what we are building is what is called as a base case. Okay, so what is going to happen in the most probable situation is what you're building. So we put in the capacity utilization basis that calculate the traffic, which is basically capacity into capacity utilization. Split it into types of traffic, EXIM and postal, and then we calculate the traffic for each category. Then you have the revenue rates. So we have taken a certain assumption, 8,000 rupees per TU, escalated it for the particular year. That rate was for FY26. We have taken for FY27, and that, if you see, escalates. So it goes from 8,200 going up to 10,000 and beyond. We say 15,000 by FY46. Similarly for coastal rate, coastal tariff is typically lower than the export tariff. There is a growth rate which is assumed 3%. Now, will 3% change? Yes, it might, right? Will it be linear like this? Will it be stable like this? No. But is it the base case? Can it be the baseline? Possibly, yes, right? How do we incorporate for variations? We take into account one Monte Carlo is what one could do on this. The other is also to look at different scenarios. We'll talk about that in some time. Then we get onto the growth rate, ground rent, and so on. So this is the rate, and we have incorporated the sensitivity here. So while you are building the model, it's good to look at sensitivity. I'm at row 50. Yeah. So it is good to incorporate the sensitivity as you're developing the model. You may do it later as well, but if you do it upfront as you're developing the module, you'll have better control and see how it's developed, right? So once you have the volume, once you have the rate, you can do the revenue estimation. So if you scroll down, row 52 downwards, you see the revenue estimation categorized by categories: EXIM container, coastal container revenues, right? Ground rent, container handling revenues, total revenues, this is there. Now, this is one module. What happens here? It's by the financial year, right? So 140 crores for the first year, 230 for the next year, 337 for the third year, and so on, broken into parts. This becomes the input to your where. Where will it go? Where will the revenues go from here? To the balance sheet, to the cash flow, to the P&L. Can we have some answers there? Revenues will get into which line? Which statement? P&L, yes. Okay. So if you see, why will revenue go into P&L statement? What does a P&L statement says? Profit and loss for the period. If you expand it further, profit from operations, profit or loss from operations. What is profit and loss from operations? It is income minus expenses for the present year, right? So that is what a income statement is. Profit minus losses, minus expenses leading to loss. Profit or loss solution. So from here, it will go into the statement. So Aditya, if you just click on statements, go to row 17. Row 17 up front, right? Zoom it a little. And let's say click on G17, right? So FY29. FY29. Go up. Go up row 17, 17. Please scroll a little up. Row 17, 17. We are having a little lag, but so 170, if you see, it says, where is it calculating from? if you see the formula bar, it says equal to revenue so and so F62. F62 is the FY29 revenue. Also, you'll notice that it is not taking any revenue in the COD years for phase one. The construction years for phase one, right? It's starting post that. If we change the COD period, this calculation will also change. Okay. So we have done revenue. Let's look at OPEX. Go to the OPEX sheet, please. OPEX sheet. It's next to the revenue. Okay, so we are at the OPEX sheet. So we have the volumes. Why we have the volumes? Because a lot of items are linked to the volumes, right? So power, how are we estimating it? Basis the volume, right? So you have the volume, you have basis the volume, you have the power in your fuel. Where is the power and the fuel going in a port project? You're doing a lot of handling, right? So there are crane operations happening. There are fuel. So when you're pulling up the crane, you're putting on what, a truck. So there is fuel being incurred. That truck is taken to the container yard. There in the container yard, a stacker or equipment which basically holds the container and puts it on a stack that operates. So there is a fuel for that. So that's where a lot of and then there would be fuel for your office expenses. Your IT system, other things, lighting, fire safety equipment. I mean, those would also consume some bit of power. So this is basis a certain norm. Will this norm be different for others? Possibly yes. Where will this norm come from? It will come from your technical studies, right? Going down, civil and repairs maintenance. What do you repair in civil and repair maintenance is basically the fixed asset which you have created. There's a certain norm which is taken, say 1%, 2%, 3%. That basis that norm, something is built up, right? For instance, here we have taken what is called as there's a tariff authority in the port sector. They have come out with certain norms. This may differ from port to port. This is a number we have taken. So this is that we have kind of calculated your civil assets. So construction, from the capex, and then insurance similarly on the net fixed asset, 1% on the next fixed asset. License fee. What is license fee? So remember we said this project is on lease, right? So it's on lease. It means the project is not the owner of the land on which it is being built, right? The land is being owned by somebody else. So you need to pay something to somebody else. What do you pay to somebody else? You pay a certain fees. What is that fees called? A license fee. It could be called a revenue share. It could be called some other option, other thing as well. So those are the options you have, right? So that's the license fee. License fee is typically calculated upfront, so we are not doing any escalation in the license fee. Remember, so your standard basis, we are not doing just a simple copy paste. We are applying our mind and creating this. So here you see, you can consider these civil costs, repair and maintenance cost, insurance, license fee, etc., as sub modules, adding up to the OPEX module. Going down, if you see OPEX estimate summary, we have made a summary and also use the sensitivity. So in case there are changes, which we'll see how to do, we'll incorporate that. So that's about OPEX summary, right? Let's look at the depreciation summary quickly. Do we have any questions here? Okay, so let's look at the depreciation schedule. So you have the capital cost estimate. This is coming from there. There is a depreciation schedule. Now in depreciation, those of you who have done CA would be aware of that in greater detail. Depreciation has different norms. What is depreciation? Basically, you're saying for wear and tear, you are making certain provisions, right? It is on non-cash expenses. You have already incurred the expense. Outgoes already happened on it. You're kind of reducing the value of your asset to the extent of the wear and tear. Now the rate is different. The rate, there is an income tax rate in India which is prescribed, or there is a company's tax rate. Those rates are different. The basis is also different. There's something called as a straight line method and a WDV method, right? So those changes, now we have taken here a WDV method and we have taken certain rates. The rates would differ basis the category, the types of assets. Why? Because it's basically based on the economic life of the asset, right? Sometimes suppose your assets may have to be written down faster, then you may be, you can take, say, a faster escalation, for instance, right? So that's there. Okay. Now, if you could open the phase one. Now, what are we doing? Now, we are now calculating the depreciation. So first, what are the additions which are being made? This is the addition, right? Capital is coming from a particular year. Now, if you see here, a point to note here is they were using the SUMIF function. You can also use a VLOOK kind of function here or HLOOKUP function here, depending on the requirement. Why? Because we are keeping it dynamic, which means suppose if you say my phasing will not be in the 2 years as planned, in 3 years. So this will change automatically without you changing it. So it's an inbuilt formula, right? Then you have the gross block. What is the gross block? Basically, all the new additions get into the gross block, and it's the cumulative value which is there, right? So 819 crores is a total gross block in this case, which we say continues going forward. But there's a depreciation on that, which is being calculated here, and gross block minus depreciation, you get the the fixed block for that year. So basically, your next net block is being calculated as the net block for the last year minus the depreciation. The current year gives you the block for the next year, for the current year, right? And total, you do this. And where does this go? Your net block is basically being going to your balance sheet, right? Similarly, you would do the calculation for phase two. Now, in phase two, Aditya, if you just scroll down a bit, if you see, it's the expense is starting from year 32, FY 32, right? So the SUMIF function is useful here. It leaves a blank, and then you do your depreciation. Your depreciation starts from when your operations start. You don't depreciate during the construction period, right? So that's how it's happening. And if you're summarizing it here, this summary, you take it down to the balance sheet, right? So we have done the modules. Now let's consolidate it, right? I'll take another 15, 20 minutes. I hope that is fine. We break, there'll be continuity. Okay, so let's go to the statements. Now we are compiling it here. How are we compiling it? We are saying volumes. Okay, so from the revenue sheet, we are getting the volumes here. From the income statement, from all the revenues we are getting from the revenue sheet here, right? And we are arranging it on a year-by basis. Here we are not using a SUMIF function, right? Why? We could use that, but because we are using the standard scale, remember in the assumptions itself, right at the beginning, we had defined the scale line, the time scale. Therefore, it becomes easier for us to just link it up. Sometimes it may be an issue where things change, and we'll see that. For instance, we saw it in depreciation, we saw it in those cases where we are putting in additional dynamics a bit to it. But here those won't be required because we are using the same scale across the revenue in the OPEX model, and so that's how we are using it. So after here you have the revenue minus the EBITDA. Now you see there is no revenue or operating expenses in the construction phase. Then you have the interest calculation. Where the interest calculation comes from the CAPEX funding sheet, right? Where does the depreciation come from? Comes from the depreciation sheet, right? Then you have the PBT, profit before tax. Here we have assumed a certain tax rate. Sometimes you may have to do a more detailed tax calculation. There is something called as a tax asset and tax liability. Therefore, tax asset and therefore tax liability. Why does it happen? Because remember we talked about two types of rate mechanism. There's a income tax rate and there is a Companies Act rate, right? And there is a MAT as well, right? So you have rates being calculated on a different basis and you may actually have different statements. So I don't know how many of you are aware. The CAs would be aware for sure. While you see a certain statement of the company in the annual report, that statement may not be the one which it is submitting to the tax authority, right? Because it's using a different schedule there. on the depreciation and therefore on the tax amount as well. On the tax, you may have certain exemptions, like there is an 80IA in the income tax which allows for a certain exemption. You are allowed an exemption of 5 years in a block of 10 years and something of that sort. You basically take those into account. So what you end up in the income statement with the key values of total revenues, EBITDA, and PAT. Going to the next one, the cash flow, right? Now, in the cash flow, there are three parts: cash flow from operations, cash flow from investing, cash flow from financing, right? Cash flow from operations come from where? Cash flow from operations are basically coming from your P&L, income statement, right? So you take that value from there. And then what do you add? You add back depreciation. Why do you add back depreciation? In the cash flow, we are basically looking at how the cash is flowing in the particular year, right? As the statement says, very obviously. So we say, okay, what is the debit? Would there be other non-cash charges as well? There could be things like amortization, for instance. Those could be there, which is not in this case. There could be, write down of say goodwill or whatever. In those instances could also be there, non-cash expenses. So those would be there. Interest we are adding back because interest is not an operational cost item. Remember, we are starting with PAT. Sometimes people start with EBIT as well, right? So we have the cash flow from operations, just adding it up. Next item, cash flow from investing. Remember, we're doing it on an annualized basis. So when we did the annualization of different modules, we are picking it right from there. That makes it easier. Now here you see in the CapExing, I'm using SUMIF, right? Because this is varying, right? And while depending on this, the revenues also will vary, but that's on a standard time scale. This time scale is different because we are using 2 phases, etc., etc. So we are using a SUMIF function to pick up the values from the respective module. So 2 years, the CapEx capital into the phase 1 is broken into 2 years. Similarly for phase 2 as well. So all of that is being consolidated here. Then cash flow from financing. The sources: internal accruals, equity, debt, and we are adding the interest as well, right? As an outgo. Why are we not putting in internal accruals here? We have put internal accruals in the financing, means of financing for capital, for the phase 2. Why are we not putting in internal accruals in cash flow statement? Any idea? Why is it not a line item here? Can we have some responses in the chat box, please? Okay, so why we're not putting is basically internal accruals means what? It is from your cash available, which you are using it. Now, what is your cash available? See, at end of the day, you are doing a cash balance, right? Change in balance, cash like additional in cash, net cash flow, opening balance, closing balance. This closing cash balance goes to your balance sheet. So internal accruals is basically this cash balance which you have, right? And therefore, when you are doing your internal accruals drawdown, you'll see whether you have enough cash or not. Sometimes you may have condition in the term sheet, you'll state keep minimum cash of so much. So then you have to adjust for that, right? Then post that, so this cash flow statement, what we are basically doing, adding up the cash flows from operations, investing, and financing, right? So if you see here, you will see interestingly on the net cash flow, row 70, if you click on that, other things you just scroll down, scroll to the right. All of it may not be visible very clearly, but what you'll see a trend, you're starting with low cash, net cash on initially and going up. Now, let's suppose there's a situation where there is negative cash. Can you have a negative cash flow? Yes, but can you have a negative closing cash balance? And when we are saying cash here, we are meaning cash and cash equivalents, including bank balances, etc., etc. Can you have a negative cash balance? No. Okay. So if there is a negative cash balance, you will have to pull in money from outside, mostly the equity. The shareholder will have to put in. That will be a condition in the term sheet for your debt. Okay. Then we go on to calculate the free cash flow to project. What is free cash flow to project? This is one measure which basically says free cash flow, also called as free cash flow to firm, which will basically be your cash flow from operations minus capex, and free cash flow to equity is free cash flow from to project, which is FCFF minus the net debt payments, right? So this would be there. Balance sheet is drawn basis that. I think we made some changes somewhere, so a error is showing here. Let me see if so here if you see that the error, we have more assets than liabilities, so we are one calculated. We will have to look in there. So for the moment, let's ignore that. We may, I don't know where we make some changes somewhere. Something is getting. Okay, so then we create the balance sheet. You have a check. So right now the check is showing an error here. This is something which we'll have to look back into as to why it's showing an error. So what you can see from the error, interestingly, is a small amount, but increasing and varying period of time. So about 33 crores error. So some small item possibly is getting wrongly added up. Okay. Change in working capital is getting. Should not happen. Let me for the moment. How do you correct it? We say for an if condition, you can't have it here. So let's see the. This is a good, interesting. Let's for the moment keep it as 0, and we'll see it. We'll just highlight it here. I mean, we'll check up later. Something is adding up. Okay, let's go to the next thing. Okay, now once we have the thing ready, so let's, Aditya, can we go to the slide, please? So slide 9. Yeah. Projections ke baad wala consolidated outputs. So we have the income statement, next cash flow. Please click enter. Yeah, all the items, returns and ratios. This, yeah. So you see, we have income statement. What do we have in revenue, EBITDA, cash flow statements, balance sheet, the key items. In return and ratios, we have profit margins, return ratios, the IRR NPVs, the debt serviceability. The inputs, where are the approach, where are the inputs coming from? From the modules. And here the idea is to minimize the connections, right? Why do we minimize the connections? So therefore, when the error occurs, you know where the error is happening from. Okay, the things to take care of obviously is the error. You have a checks and balances to do, and also ability to do analysis. What do we mean by that? You can do slice and dice. Can we? Aditya, can you just click? Okay, so there is slice and dice, which means what? If you have to look at different angles to the whole thing. No, what is the share of a certain revenue segment? What happens if the project is delayed? What happens if we increase the revenue period, the construction period, etc., etc.? So those options should be there, and which is why the dynamism is there, right? And minimize inputs in the output sheet. Okay, going back. Okay, let's be on this slide and let's cover the next portion as well here. A sensitivity in scenario. Okay, we'll talk about it and showcases here as well. Can we go to the next slide, please? We are doing, so once we have the output, we do the sensitivities. What on sensitivity on what? On all the key variables. What are the key variables? Your IRR, the outputs and the key inputs, right? Scenario analysis is the sum of these inputs. We'll show here and then we'll see how to present it. Remember one thing we have said at the end. Can you please keep clicking to the end, Aditya? So the important point here is that the model has to be useful for your decision making purpose, right? So utility is the important part, and the things to take care, as we said, in the language and KPIs of the decision maker. So if you're sending it to the bank, if you're sending it to private equity, if you're sending it to your management, if you're sending it to somebody else, the tax authority, the concessioning authority, etc., etc., it needs to be in their language. Self-protection is one idea we need to take care of. We have not done the self-protection here. Is something which one should take care of, or at least keep checks in place to help it you know where the errors are happening. Why are we doing some scenario analysis? Because it helps in decision making process. And how do we help and modify our particular model? We align it with the decision making process by talking in the language, by keeping high utility, by allowing these variations to be there. Let's go back to the project returns. So the model, please. Statements row 101. Scroll down to the project returns. So here what we have done, we have calculated the FCFF. This is the project free cash flow to firm or the free cash flow to equity. Project. What have we done? So basically it's PAT, tax adjusted rate, depreciation, changes in working capital, and capex, right? That's giving you the free cash flow, discounting it. You take the IRR of it, which is basically you say to select all and do it. Here we are not taking a terminal value case for this because we are defining a certain period. Then we do a project NPV. What do we do the project NPV at? What is the discount rate we are taking? The WACC, right? What is WACC? The weighted average cost of capital. What is the weight? What is the weight? Which is the ratios adjusted for the tax if where applicable, which is basically for the debt, right? So what is it saying? 22% IRR. What does it mean? Is 22% IRR a good number or not? Let's have your views. Is 22% IRR a good number or not? And why, if you can also say that. Can we have responses in the chat box, please? Yes, somebody? So what is a reference point you use, right? When you say 22% IRR, what does it mean? Right? We are talking about this project, say in an India context. So we use the benchmarks of the in India context. Second, we use the context of the fund of the project itself. Versus what? Versus the 7.5 to say about 12%. So 12% is a good margin, right? Second, versus the opportunity cost, a good return? Yes, it's not a bad return, right? So 22% is a good return. Normally we say, in India, I mean, an IRR of say 14-16% is not bad, right? So this is a good number per se. But a point to consider here is a lot of value is coming in at a later date. So if you see initially you're getting negative cash flow, there are years of negative cash flow, free cash flow in between, and then going forward, the values increase. So a lot of value to this is coming at a later date. So if I were to do an IRR for say instance on a shorter period, say say for the first 5 years, I get an IRR of minus 23%, right? So that's not a good number, right? If I take it, say, okay, for first 10 years, now that's also not a good number, right? It comes to say 10% or 11%. So that's not a good number. So a lot of value is coming from outside. So when you are doing this IRR calculation, remember that IRR kind of disguises and can make you confused about the return profile. So you have to look at the return profile. Somebody is looking at a return profile at a faster rate, may have an issue. For instance, if you do an accounting-based rate of return, right, payback period, basically saying cumulative cash flow by initial investment, so it says 6 years. Somebody who is not happy with 6 years will look at IRR and say 22% is good, but I'm not getting my payback in this year. So a single measure is not a good measure. You need to look at a project from different measures. A banker will say, let me look at the DSCR. Now, if you see the DSCR here, the minimum DSCR, what is the DSCR basically? Net operating income, which is PAT plus interest plus the depreciation divided by the debt obligation, interest plus principal, right? That the minimum is 1.06. It's low. I want a minimum of 1.2, right? So people may have different variables. Now, your model, while it is saying that overall it's good return, there are challenges in between, and there are challenges for different players, right? Now, how do you allow for that and see what can be varied and how much to vary for? Just before we go on to the sensitivity part, there are other measures could be your equity IRR, right, which is based on the equity flow to equity. So let's go to the sensitivity. If you could click on the sensitivity, please. So in the sensitivity, you see, we have done two things. One is a sensitivity analysis, one is a scenario analysis. In the sensitivity analysis, you're basically taking one factor and changing it, right? So for instance, I say 10% increase in capital cost. So if you see, my project cost here goes to 1822 versus my base cost of 1767, right? This is approximately say 20 and 50 crores more, right? Interesting. The IRR is changing a bit. We'll have to see your minimum DSCR, your IRR is going to 21% versus base case 23%. Your minimum DSCR is going under 1. So a 10% increase in cost is a worrying thing, right? For phase 1. For phase 2, let's say suppose it's delayed. What happens? Your IRR goes down by 1%. Your DSCR remains at 1.06. So because there is a lot of internal accrual funding, debt obligation is lower, DSCR is better, capital cost again goes up, right? Your average DSCR is comfortable. So now you look at change in traffic volumes. Okay, let's suppose I do -5. And remember, this is in percentage points. So we are doing calculation in capacity utilization terms, right? So your project cost would not change, right? This is post construction. But your IRR is coming down, right? And your minimum DSCR is coming down significantly at 0.68. So your traffic volume is a big concern. Why is IRR not coming down significantly while ASR is coming to be very low? Because a lot of IRR returns are basically coming from the later years, right? So that's a scenario. So let's put it as 0. Revenue rates, let's say -5. What happens? IRR goes down by 2%. Minimum DSCR goes below 1%. Equity IRR remain, is down by 5%. Project cost remain same. Equity NPV goes down. Project NPV also goes down, right? Now, this is how we do the sensitivity analysis. Then you do the scenario analysis. What is the difference between scenario analysis and sensitivity analysis? Basically, you say, let me do a combination of factors. So here, for instance, we have predefined it. So normally you take a base case, optimistic case, pessimistic case. You say capital cost lower by 5%, traffic volumes above by 5%, revenue rate above by 5%, OPEX down by 5%, right? Optimistic. All the good to have cases. There you see your IRR is 4% up. Your project NPV is almost 500 crores up. Minimum DSCR is 1.25, right? Remember now, if your bank was saying 1.25 is what we desire, possibly this is the state, this is the scenario which they expect as a base case. See, now here the model is helping you decide, okay, we need to ramp up the volumes possibly. We need to decrease the cost by somewhat. We need to adjust the volume. So you'll go back to your drawing charts and see where and how you can do that, right? So that's how the model is helping in the decision. What decision you take is ultimately, yours and whoever is the deciding authority. But it is helping you that we are allowing for that variability, that flexibility, that dynamism. That's what is the role of a financial modeler. Okay. Similarly, we do a pessimistic case where we say everything goes bad, project cost increases, traffic volume growth is lower, revenue rate is lower, and OPEX is higher. There you see versus the base case, 19% versus 22%, minimum DSCR of 0.38, which means what? The moment your banker sees this, say, no, I want my cash. I am not going for 70-30, 60-40 crore या 55-45 crore. Equity ज़्यादा डालो, या corporate guarantee दो, या personal guarantee दो, etc. ऐसा आ जाए, right? Now let's look at. We have talked about a certain term sheet, and before we take a break, let's look at one part, which is your debt sheet term, typical terms. Can we go to the PPT, please? Yeah. So what are the terms you have in the term sheet? How many of you have seen a term sheet from a bank? Suppose equity IRR is same. Okay, so there is a query. There's a poll. The question here. Please, you can submit your votes. Suppose equity IRR is same as project IRR. Is a situation desirable? Can it happen? It's fine, depending on situation to situation. Not desirable. Why should it depend on the situation, and why is it not desirable? Anybody wants to clarify? It's not desirable. See, remember, what is your cost of debt? 11%, 12%. What is your cost of equity? 16%. Why is cost of equity greater? Because you're creating greater risk. Why are you taking greater risk? Because you have a lower priority, right? And therefore, when you are taking greater risk, you have higher expectation, and therefore you say my rate is higher, right? But if your expectation is higher and you're getting the same as somebody who is taking lower risk, right? You take lower risk, but you get the same return as somebody who's taking lower risk. Would it be desirable for you? No. Even from a bank perspective, the banker will say, यार equity वाले को return नहीं मिल रहा है, right? The equity वाले will not be interested. So the skin in the game will be low, right? So they are also okay with a higher leverage. So typically you will have debt greater than equity in most project finance, right? So let's look at that term sheet. Any queries so far? This is the last slide we're talking about. Then we'll take a break, and then we'll come to valuation and Monte Carlo simulation and financial analysis. Those are smaller bits based on a lot of what we have talked so far. So those will be useful, right? So let's look at the the debt terms. Funding amount, this is the amount which the bank would, state would be able to give, and type of facility. So it could be in what currency, what those terms would be there. So how does it impact the financial modeling? This is the maximum amount you can take, and there would be other, say, for instance, subject to disbursement clause, right, which is mentioned below. How and when the money will come and after what? How, when, and after what is what your disbursement clause basically tells you, right? Funding amount, tenure, which is, so the typical term uses end-to-end tenure, repayment period, moratorium, construction period, etc., etc. Tenure is basically end-to-end, right? From the day of the first disbursement to the day of the last repayment. And there is a moratorium in between. Moratorium on the principal. There is no moratorium on the interest. Cost of facility, right, which is your interest cost, plus there could be other costs. Remember that, a bank likes to have fees income, and they'll say 1% processing charge, 0.5% processing charge, this charge, that charge. So all that you have to include it. Plus there could be provisions for penalties in case of non-compliance. So those also may need to be incorporated in case, say, for instance, you're building a model for the bank. Conditions precedent, these are conditions precedent to funding being there. So they'll say, all the legal provisions have to be in place, provisions have to be in place, etc., etc. Disbursement clause, when, again, when, how, and subsequent to what. Security is, what is the security cover? Typically, they'll say at least 1 times the security cover, but that's a very ideal situation. It typically be like 1.2 times the security cover, which is why when you say minimum DSCR of 1.2, that number of 1.2 is also, very broadly coming from the security cover that you want. DSCR is basically saying your cash flow is giving you some kind of a security cover. In India, what we call as a project finance is a lot of times an asset funding. Across, in a more mature market, project finance basically just has access to the cash flows and nothing beyond. So corporate guarantees, etc., etc., would not be there as much. Even in India, we have made a change, a step forward. There's something called as a substitution agreement in concession agreements. I don't know how many of you have heard about it. In the substitution agreement, what happens is, we say a lot of project finance to project PPP projects, public-private partnership projects, are secured, but they are not secured in the traditional way because the asset is not owned by the concessionaire or the project operator. It's owned by the authority. And whose authority? The government. And basically, when you say the government owns it, it's the public which is owning it, right? And a bank cannot take an asset on a security on an asset. A bank cannot take security on a road or a port or even port. I mean, technically it would be possible, but practically, a bank, what would we do? Right? If you take a security, you'll say, I'll have access and right on the asset. Will you be able to stop the public from using a certain road? No, right? So that security is basically on paper. So what is the security look at? There's something called as a substitution agreement, which basically says that if the original party, the project operator, is not able to operate, then I'll kick him out and get somebody else who's going to operate. And who kicks out? Who has the authority to kick out somebody? Getting somebody, obviously subject to clause conditions, but it's the lender who has that right. So which is where you have the substitution agreement coming in place, right? Covenants, which will say, don't debt EBITDA margin should not be lower than this. Volumes, certain other ratios, current ratio cannot be lower than this. Debt to equity cannot be lower than this, etc., etc. Those covenants will be in place. If covenant is not adhered to, penalty clause will come in place. And then there are declarations by the project owner and so on. So that's there on the project funding the project finance model per se. Big queries. What are the questions so far? I know we have been talking and we have been hearing for a long time, but do we have questions as of now? Yes, please. You can put in chat and maybe we can. Yeah, so let's also, an interesting question which has come. Which is the biggest risk in the infrastructure project? Okay. Financing risk depends on project structure. That's a. So all of these answers are correct in a way, right? Demand risk often in a well-structured project, demand risk is the biggest thing, right? Interest rate risk sometimes could be a big issue, especially when you consider interest rates with hedging costs in a where this, the funding is coming from outside. For instance, I don't know how many of you have you heard recently, a lot of yen rupee loans have had problems, right? So yen, in the yen market, you could, Japanese market, you could borrow at a very low rate, convert it into dollar, or then convert it to rupee, one way or the other, and you were basically had an access to a low cost of fund. There was stability on both the currencies, and therefore it was assumed to be low. But then that suddenly increased. So you had you had an interest rate risk there. Interest rate does not change as much in India, and in most projects you will take kind of some leeway in terms of how your project structure itself. Financing risk. So the interesting point is, unless you achieve a certain financial closure, you will not have no funding will come in from the bank, especially, right? And the bank will put in a certain condition of equity being visible and clear up front, okay? And then they'll take corporate guarantees, etc., etc. So while financing risk may be there in projects, a lot of projects actually don't face financing risk. Also, what happens is, if you're past the first 3 to 5 months, and this I'm telling you from a practical perspective, once a lot of money has already gone in, what are the avenues a bank has? If you stop right then and there, what you have is, half structures created, a foundation laid, maybe a plinth placed in, maybe orders placed for certain machinery. Who will buy those? Nobody. So the bank typically takes a call saying, okay, let's complete the project, maybe with another party, maybe with another contractor, and let's see what happens from. So interestingly, your financing risk theoretically seems to be high. Practically, the financing risk is not as significant, right? Obviously, it depends on the project structure. By project structure, we mean what? The capital structure itself. Who is taking what kind of risk, right? Because in the project, there are multiple parties, multiple stakeholders. Somebody might be, you see there, before the PPP regime, what used to happen was, in the government, a lot of contracts, which is happening, say, even in the railways case. So railways is a logistics field. Railways puts all, in a lot of railway concessions, a lot of risks are put on the operator, and a lot of rights are given to the railways or the concessioning authority, right? So it's a skewed thing. The project structure itself is wrong. For instance, it will say railways will provide the engine power as and when possible. Okay, railways will provide wagons as per availability. Very good. But when you look at the practical thing, railways will say, when I'm looking at an availability allocation, I will prioritize my requirements before you. So while the wagon is available, there is certainly a shortfall. The railways will take the first wagon, will take the first engine, will take the first right of way. So therefore, you are left with, a lower priority and a higher risk. Whereas technically, you will have the right? And because there is a certain monopoly, you can go and negotiate upfront. This was a case which, say, happened in roads also. Those got corrected, and so on. And in certain cases, like say a multimodal logistics park, a major amount of risk is on the operator. The government will say, at best, I'm giving you the land. Now, what you do with it is fine. Give me a certain return. I am saying a minimum guarantee. Rest you manage. You build whatever you want. You build whatever you do. I mean, obviously there will be some minimum requirement. You operate at your risk. You may build and put a key, a lock-in key on the door, but still you have to pay me something in the end of the tenure. You have to maintain the asset, and in the tenure, give me the thing. Right? That might be the only risk I'm taking. All the risks are yours. So those kind of project structures might also happen. So when we talk about project structure, a lot of it is given, a lot of it is implied, and a lot of it also comes from practice. So the leeway you have is kind of limited, right? So you're coming with almost like a predefined risk. So that's largely the point on the financial model. I hope that you guys have got some bit of clarity on this, and it was useful so far. Can we have a quick poll on it, Aditya? You understand better clarity? Yes, no, not sure. Aditya, if you could put a poll. Yeah, okay.
Yes, sir. Yes, I'm doing it.
Okay, anybody else? Any queries? Any questions? Nothing? Yes, so after all this long session and a lot of talking and a lot of listening, okay. For those who have had somewhat, do you want to put the your questions later, or if you want, we can take the questions right away? So let's keep we may keep your questions for later. We'll have a Q&A session at the end anyways. What we'll do is we can have a break. Aditya, we can have a break right now, 20 minutes.
Yes, sir. Sure.
So it's 1:45 by my watch. We come back at what? 2:05.
Yeah. Yes.
Is that good?
Yes, sir.
So at 2:05, I hope it's fine with everybody else. At 2:05, we start with the Monte Carlo. It's something which would interest you. There's a new message, right? So let's then reassemble at 2:05, right? Another 20 minutes.
Right, sir.
See you there then. Can we restart? Start this second session?
Yes, sir.
Okay, so quickly we'll do the valuation, then we'll go to the Monte Carlo and then the financial analysis. So Aditya, if you could just go to the valuation slide.
Sure, sir. 1 second.
Yeah. The next one. So just look at the theory first. So what are the common valuation methods? For infrastructure in particular, how is the infrastructure asset different from, say, a other type of regular assets? For instance, there is a typical construction period, a waiting period where no revenues inflow are coming in, a lot of outflows are happening, and so on. So it's the nature of the cash flows are different. Also, possibly the level of steadiness, the level of even the capital structure, all of this is different. So given that the project finance or infrastructure is typically different, would you have a different valuation method? Now, generally there are two methods, DCF and a comparable method. Both apply to infrastructure, and when you say apply to, it means the practitioners, the people who are investing, people who are funding, both use these valuation methods because ultimately valuation matters to them the most. A prominent method is the DCF method, and we'll just see how it works, and as well as a comparable method, right? What are the key components of it? The key components are what we basically look at is the cash flow. When doing the DCF method, we look at the cash flow and we look at the cost of equity, the cost of the capital, the relevant capital, right? And then there is a case of a terminal value in certain projects which extend for lifelong, right? You can't do projections for till infinity or for the next 100 years. Doesn't make sense. You're just basically extending it. Rather than that, is there a summary formula available to do that? That's a terminal value, and we'll see how it works. The standard formula to calculate that. And see, in terms of in the financial model for infrastructure segments, right? How do you look at the valuations per se? Generally, you'll see, because by nature they are heavy asset built, the heavy asset component. They tend to be more steady in terms of cash flow, also in terms of their valuation, right? And those aspects tend to take place. Now, why are we doing all this, right? Valuation, the idea of doing valuation is that helps in raising capital. Like if you were to ask somebody to invest in a total project, they say, okay, fine, I'm willing to invest 100 crores, but what will you give me in return? You say, I'll give you so many shares. How do you value those shares, right? That's where the valuation comes in. Valuation can also happen when you're doing, say, an asset sale on block, right? Or maybe say even in recovery of loans. So those are the situations. Let's look at the example in our particular case. Aditya, we can go to the Excel model, please. And let's look at the statements. Right, go down to the cell 150.
Wait, can you see my screen?
No, I'm still able to only see the.
Oh, just 1 second, sorry.
Excel model statements. Scroll up. Yeah, just scroll up. Okay, so here you see the DCF method and the valuation comparable method both being there, right? So what are we doing? We are looking at, so there are two cash flows which we are having. the cash flow you basically take is a free cash flow, which means after taking into account everything, what is left. That's the free cash flow, right? The free cash flow is calculated at two levels. Cash flow available to the free cash flow available to the firm and to the equity. Free cash flow available to the fund, as we said, is basically your operations minus capex cash flows, right? So that's the idea. Now, that's what we have calculated above in the. So what we're doing is we are discounting it a certain rate. Now I have taken 10% here. Now our WACC is what was when we use doing NPV, we use WACC. Would the discounting rate here be different? Possibly. Yes, because when you're discounting it possibly perspective of somebody else. Their cost might be lower, so they would possibly be discounting it at a different rate. So the idea is, while a 10%, 11%, 12% might be a debatable point of view, but when you're doing valuation, you're not exactly using WACC. You are seeing it from the perspective of the investor or who's coming in, right? So that's there. So basis that the NPV, say basis the 10% rate, NPV comes to 1700. If you do take the rate to say 12%, your NPV will go down to 1200, right? So your NPV comes to 1200. Now, after NPV, what do you do then? Is it the value of the company? No. This is the net value added over and above the investment. What are the investment which is happening? The investment which is happening is the capex. But remember, in capex, you're also using internal accrual, so part of the cash flow is going there. Therefore, you're using only that part of the capex which is relevant here, which is funded by external capital, which is another way of calculating that is to take the debt and equity. That's external. So in the NPV, you calculate the enterprise value, right? Now, if this was a situation where terminal value had come into place, then we would use the terminal value. So I don't think we could go to go scroll right and go to column Y. Scroll right, not but low, right. Yeah. So there's a terminal value. Now, if you see terminal value here, there's a formula there. It says last year's cash flow into 1 plus the terminal growth rate divided by terminal growth rate, a discount factor, divided by terminal discount factor minus terminal growth rate, right? So in the denominator, you have the difference of, so basically represented, if you look at your finance textbooks, they'll say cash flow into 1 plus G by R minus G, where R is your discount factor, G is your terminal growth rate, right? So here we have taken terminal growth rate as 3. And discount factor as 12. And those are variables, those could be changed. Right? Those are reasonable variables. People may have different opinions on that, those could be changed. Now, basis that the terminal value increases. Now, if you do a comparison, say if you look at the NPV and NPVT, right? You have say 1,200 and 2,300. Now these values are significantly higher, significantly different. Why? The only change between the two is a terminal value is being added. What you're essentially doing is you're bringing in all the the future post 20 years all the cash flows into account here. Technically, I mean up to perpetuity, but I mean as you go longer, those impact becomes far lower, but still it's there. So what happens? A point to note here is, irrespective of how you're doing and when you're doing calculation, your terminal value becomes an important point. Often in your valuation negotiations, there will be a case of how you deal with the terminal value. Okay, so that's one point. You could take the calculations basis the free cash flow to equity as well. Now, if you notice, the values are slightly different. You're saying I'm using the same model, but when I do it at equity level, I'm getting a certain return. When I'm doing it at a firm level, I'm getting a certain return. Those are different. Why? Because the way in which you are, there's the way in which the debt is treated is different from how your equity is treated. Debt gets a certain tax treatment. Debt flows are not regular. right? There is an interest payment on debt which is happening. So in a classical, so in a scenario where debt and equity were basically treated as same, you will get the same number. But when the debt and equity is not treated same, as would be in any normal, in any case, any practical case for sure, you will generally have a different value, right? Also, the discounting rates are different. So if you see, it's the initial years where the cash flows will be different. Once the debt is paid, those cash flows start becoming the same in FCFF and FCF, right? So that's one method. So you get an enterprise value, let's suppose, without considering terminal value, enterprise value of 2,200 and 2,800, right? At variance. When doing a comparable variation, let's suppose you use a EBITDA multiple of 50. Say, okay, your Adani is going at that number. In Indian market, you don't have too many peers for this segment. But let's suppose you use a wider logistics sector base. Let's say the 15 car base and all that stuff. So depending upon, I mean, this is again a debatable point. Sometimes somebody will have an opinion saying 12, you will like a 15 yeah, if you're on the seller side, you'll say it should be 18. So these debates will happen. And this is that you take. Now, what EBITDA to take? Would you take the year one EBITDA? Year one EBITDA is 0. So your valuation will come to 0. Doesn't make sense. There is some value to the project for sure, right? You are putting in money. That's one value, right? Assets are being created. Asset has some value. And asset has the inherent value as part of a network to generate cash. So that is the intangible value which is getting created, right? Like how you say there's a potential energy in the asset, right? Potential energy cannot be measured in its whole quantum. The difference is what typically how you measure it. But you basically say there's an asset which is visible, there's an intangible asset which is a potential to generate as cash flows subsequently. All of that put together is what the value is, and there would be debatable. So you take a future value. Now, if I take a FY30 value of EBITDA and a 15 multiple, I would get a value of 2,100 crores. Maybe somebody says, okay, 15 is today's value. Tomorrow you're taking it 3 years hence. So let's discount it to 12. EBITDA multiple to 12. To 12. Okay. Now, overall, you're saying what you do is you use different methods and then you take an average of this. Remember one thing, very important, value is a perception. Okay, value is not a number which comes out definitely out of a scientific calculation. DCF brings in a certain rigor to the calculation, right? If you see, yeah, 15, like we say 15, 16, 17, 18, ये random ruler wheels से चलने लगा. In the when you're doing the DCF method, you're at least applying some logic to it, saying, okay, I am getting into the subcomponents. I'm guessing at the subcomponent level. Okay, even if it's a wild guess, I'm doing it that, and there is a certain logic to how the cash flow is coming. It's not a random turn of the coin, right? If you look at the EV/EBITDA multiple, depending upon when and from which market and what comparables you use, the numbers will change. So there's always a challenge. That is why all methods are accepted. Also, you take an average of that, and ultimately it's a matter of opinion. But what does a model do? Like, is a model useful? If everything is a matter of opinion, why calculate at all? Model provides you certain, benchmarks, certain pegs around which you can do a discussion. So you see the range is say around 2,000, 2,500 crores, right? The value 2,000. So it's in that range. It's not 10,000 crores. It's not 500 crores, right? It's also not 1,000 crores, which is what you are doing as a capex, right? Or 1,700 crores. It's more than 1,700 crores of capex. How much more? The potential is where the opinion would differ. Somebody would say, differ because you expect faster growth. Somebody would expect a conservative growth. So that's a matter of opinion. If you are a seller, you want a buyer who appreciates its wealth. If you are a buyer, you want a seller who is conservative in his aesthetics. So that's how the matchmaking happens between the seller and the buyer and how the valuation is used. But from a model perspective, it gives you certain benchmarks and a basis of calculation. So that's what it is when we come to valuation. So that ends with the valuation. Now we will go to the next part, which is your Monte Carlo. But before we go into the next part, I think we may have a question. Do we have a poll, Aditya?
Yeah, yes,
one
sir.
question here.
Just a minute.
Kashish will be taking the next part on the Monte Carlo.
Yes, sir.
Yeah, so we have a question here. Is how is the valuation of a project decided? Decided by the government, decided by an authorized entity, decided by the market perception, equal to the person. So let's briefly take your this is some a few people have picked on authorized entity, a few people have picked on market perception. Market perception is what ultimately defines the value. The authority also decides basis of market perception. Like for instance, I don't know how many of you are aware about how the land price is determined. So there is something called a circle rate in India, which is a notified rate saying that the average rate, benchmark rate for land in a particular area is defined by that. And typically, there's a block, village, ward, and those kind of segregations which are used. Now, technically, it's coming from an authorized entity. Generally, the commissioner or the district magistrate is the authority who's doing the valuation. But it is based on something. It is based on the average, some kind of a weighted average of the transactions which have happened in the preceding X months, right? X, how many months to be taken is determined by, various, may vary from state to state. Second, for instance, let's look at the equity valuation, right? Now, SEBI, for instance, when you're acquiring a company, SEBI says that you have to give a price not below a certain value, right? So in a way, SEBI is intervening in how the valuation is decided. But what it also says is that the valuation would be greater than or not less than the average of a certain period average of a certain preceding period, right? So in effect, the market ultimately is what decides the play, right? So that's from the valuation part. Any questions before we go on to the thing? In the meantime, Kashish, you can just load your
Yes, sir. I'll
slide
share my
and-
screen.
any questions on valuations? Nothing. Yeah, Kashish, you can proceed on the.
Okay, then I'll get started. So far, what we have seen in the financial model is that we're working with fixed inputs. Now we bring an interesting addition to this financial model, which is our Monte Carlo simulation. So when we're working with fixed inputs, of course, we get fixed outputs, right? But as Rohit sir in the starting of the webinar rightly mentioned, that some of these inputs are extremely sensitive to changing market conditions, especially in the case of infrastructure projects where changing interest rates and other macroeconomic factors significantly impact our input values. What it does is that it introduces uncertainty in the selection of our input values because we cannot rightly select one particular value because it keeps changing because of the changing market conditions. And what we want to do is to essentially introduce this variability into our model so that we assess the risks of our outcomes based on this changing volatility of the market. So this is where we bring in our Monte Carlo simulation. So by definition, it is what is a simulation? A simulation is a replication of a real world scenario, right? And you keep iterating that. So by definition, we convert a deterministic model, that is a model with single point inputs, right, with fixed inputs, and we convert it into a probabilistic distribution. Now, I'm very sure that most of you are familiar with the term probability, but what does a probability distribution mean? Let's get into that a little bit. I'll give you an example. So in our working case that will follow after this presentation, we will be working with the cost of debt, which is an input value. And the cost of debt is taken to be 10% in the actual case. Now, suppose I want to increase this range. I want my cost of debt between 6 to 14%, let's say, with the mean being 10%, right? So now there are a lot of ways to get this. I want my cost of debt to be in the range of 6 to 14% with equal chance of every possible outcome in this interval. This is what you call a uniform distribution. That is, in the range, every outcome has an equal chance of occurring. Now, suppose I want my mean or my most occurring value to be 10%. So my mode is 10% and most of my cost of debt inputs is coming around to be 10%. So then we will have a normal distribution, which is symmetric about the mean. So the probability distribution, in a sense, it changes the likelihood or the chances of occurring of a given range. So as you keep on changing, as you keep on taking different probability distributions, you will get different outcomes of the same given range, for instance. Here, in our following example, we will be working with the norm inverse. Now, what happens after we keep changing our inputs, right? So you put in an inputs, you put it into your financial model, and you will get different outcomes in each iteration. And what this will do, it will generate a set or a range of your outcome values. What it will help us? Now, this will help us to identify, again, the distribution of your output. Why is it necessary, you might ask? So now we do not only have one single value. Now we have a range of values, and the basis of that range, we can compare it. We can compare it with the base case. For instance, we will be working with the internal rate of return. And for instance, let's say our IRR is 12% in the base case. And I want to see that what is, the possible probability of getting an IRR greater than 12%, right? What is the range that I'm likely to get so that I can better assess my outcome? Because a range, it will tell us what is the uncertainty associated with my outputs. Why does it matter? What is the purpose of including this integration of Monte Carlo? So it introduces reality. Now, reality in the sense, whenever you're working with inputs, like the entire idea of Monte Carlo simulation depends on what your assumptions are on your input probability distribution and its parameters. If you're able to correctly assess the distribution based on the changing volatility, you will get the most accurate results that replicate the real world scenarios. So I want to assess the risk associated with my output based on these changing conditions. Okay, so given that this is a brief introduction of what the Monte Carlo simulation is, I will now dive into the steps involved in performing this exercise and how you can integrate a Monte Carlo in an existing financial model. Just a second. Okay, so is my screen. Okay, so let's get into this. The first step is the selection. Okay, so the first step in this exercise, or you can perform this exercise in any case scenario beyond finance, it is the selection of your variables. Now, you can select any input variable of your choice, but you should ensure that it has a direct relation to your output value. Along with, it should be volatile in its nature, otherwise it doesn't serve the purpose of your Monte Carlo. For this exercise, we will be working with the inputs cost of debt, cost of equity. All of these terms have been explained by Vivek sir in the previous first half. And for our output values, we are working with NPV, which is in crores, and then we will be working with the project IRR. So now I have taken, these are the actual values or the base values we have. And now we want to see what will be the ultimate impact on these base case values after we run our Monte Carlo simulation. So the idea, first of all, is your selection of variables. Now we move on to assigning the probability distribution to inputs. Remember, this is the most important part of your Monte Carlo, because if you're not able to correctly identify your distribution and its parameters, your entire model will be flawed. So your end results will depend on whatever inputs you provide. In our case, our base actual values was 10% and 16% for the cost of debt and equity. And I will now increase this range by plus minus 4, right? So there are two usual examples of in finance that we use for probability distribution. The first one is a triangular distribution. A triangular distribution has a mode, a minimum and a maximum, and all of these inputs vary within this range. The second one is we have a normal distribution. I'm sure a lot of you might be familiar with the normal distribution. It is a symmetric distribution which is centered around the mean. What does it mean? Most of your values will be somewhere around the mean, and a standard deviation basically measures the spread from the mean, right? So the diversion from the mean. As you increase your standard variation, your values will divert away from your mean. In this case, we actually have a very large range. We have a plus minus 4 range for our inputs, and we also have a standard deviation of 2%. So now in the calculation, in order to get our changing input probabilities, I am using a truncated distribution. So a truncated distribution basically allows us to get our normal distribution within this range. And for that, I've calculated the CDF. So now I'll show you how we are using the norm inverse. So the norm inverse has 3 parameters, right? So we want it to be in the range. So that is why we have calculated the truncated probability. The second, using this function. And the second is the mean, which I have referenced from here. And then we have the standard deviation, right? Similar exercise has been done for the cost of equity as well. We have also introduced another input, which is the capital utilization. Now remember, you can introduce any inputs of your choice. Remember that it should be volatile, it should be significant to your model. We believe that capital utilization is a very uncertain quantity. So we keep on changing it. In the actual model, it is 15% and 10%. And now I want a base cap of 10%, increasing up to 15%, right? So now you see it keeps on changing. Every time I'm doing this manual calculation using F9, and every time I keep pressing it, I'm getting a change in the values. So these are the first 2 steps. One other point is that in assigning your probability distribution, ensure that you do a historical analysis of whatever inputs you have, because you would want to correctly identify that parameter and the distribution. Okay, so now we move on to the third step, which is the Monte Carlo simulation. This is, we have done 100-step iteration where our input values are cost of debt, cost of equity, the output is NPV and IRR. I'll show you an example of how it has been performed using a data table. So let's go here. So a data table is simple. I'll just delete this first. You would want to essentially reference your changing values. So cost of debt has been referenced from E7, which is here, right? So this cell, which keeps on changing because we're using a RAN function here and a normal distribution, it keeps on changing its value. So we are using this as a input. Similarly, we have done this thing for cost of equity. And for the NPV has been taken from the statement file. I'll show you here. So you go to your statement file and you get this problem NPV. So I'll just reference this. Right. This has been referenced. What is the data table now? So a data table, now what we see here is that our inputs have a change in nature. So they keep on changing. Now a way to record all these changes and a way to record all of my inputs and outputs, you can add another additional input here. For instance, if I want to see IRR, I'll just write IRR and I'll reference the changing IRR from its given statement sheet, right? If I want to record this change, I will use a data table. What I'll do is I'll select this entire table. I'll go to my data, then I'll go to what if analysis, data table. The table has already been selected, but for my column input cell, I'll just select an empty cell. And you see there has been some error. I'm not sure why that's happening. But yeah, so you see this, it keeps on changing because our inputs have been changing. And those, now remember one thing, you need to ensure that your changing inputs have been referenced in all of your calculations. So every calculation keeps on changing with just the change in this cell. So that reference is very important. So this, up until this step, we have performed our simulation and our iterative process. After this, we move on to the descriptive statistics. In the descriptive statistics, we have calculated the mean and the standard deviation. So remember, in our base case, we were getting an NPV of 742. Now we're getting a mean NPV of around 707, which is somewhat near to our base case example. Also see that we are getting a very high standard deviation. It is about 182 crores. So that means that for a 2% change in the cost of equity and cost of debt, we are getting a 182 standard deviation or uncertainty in our NPV. So we also want to understand the effect of each of our inputs on my output variable, which is the NPV again. So one way to do that is to show the min-max of depth and the corresponding change in the NPV. So there is not as substantial change as you would see in the cost of equity. So for a minimum cost of equity of 12.39%, there has been a very high NPV recorded. So if you see the difference of these min-max, it's pretty high. And that is not the case with the debt situation. I've also calculated the correlation. So for the cost of equity, the correlation is coming out to be extremely negative, which justifies the theoretical assumptions. So it is also shown in the graph as well. The relationship between cost of equity and NPV is very negative. That is not the case recorded for debt, which should have been, but now here's a reasonable justification for this. So the debt repayment has stopped after financial year 36, but your calculation of NPV goes for a very long time. What I'm trying to say is that NPV has a very longer duration, but your cost of debt has a shorter duration compared to it. So its effect has not been calculated, has not been recorded to say that well, because there has been a change in the recorded values. Okay, so one very important thing that we want to see is the probability of exceeding thresholds. So what is the probability that I am getting my NPV more than my base case? It is coming out to be 41%, which is decent. But another thing is that 59%, in 59% of my cases, my NPV is recorded less than my base case. And I've also calculated the range for my NPV and IRR, which lies somewhere between 400 and 1200. And for our IRR, it is 19 to 21%. After all of these descriptive statistics, we want to understand what inference can we make out of this exercise. The very first thing is your IRR lies between 19 to 21%. At the same time, your NPV is very uncertain because it ranges from 400 to 1200 with its mean 700 and a very high standard deviation of 182. This indicates that it is very sensitive to the changes in your change in depth and equity rates. Right. One other important thing that we noticed was that 59% of our base cases was less than the recorded. 59% of our cases in the Monte Carlo was less than the base case. And this has been shown, like this decrease has been recorded here. If you would see in all the cases where your recorded NPV is less than the base case, it is a condition of high cost of equity. And now this again links to our graph, which shows that cost of equity has a very high impact on your NPV, at least for this example. And so these are the effects and these are the inferences that we have recorded out of this exercise. What can we ultimately say about it? We have a positive NPV in all the cases, and we have a good IRR as well. So at least this exercise reflects a good project. Now I'll finally conclude what we were doing. So now you have a rather extensive analysis of your output variables. You have a range, you have its uncertainty, and if you're able to correctly, identify your assumptions, you will be getting a very realistic Monte Carlo simulation and the results, which will replicate your reality. So what I'm trying to say is that you should do this as an exercise apart from your financial modeling. Use it in addition to this because it will provide you further more information about your project. The only thing is you would require a correct identification of your inputs as well as a correct analysis of your inputs, that is. So that concludes this exercise. If there are any doubts,
if
please put it in the
may
chat
add
box.
something here.
Yes, sir.
So see, Monte Carlo simulation as a technique, what it says, that's one output, and the process itself is a value add. So for instance, Kashish, if you could scroll to the right where we have pasted the values.
Right.
Pasted the values. So there you will see, situations where your NPV, is higher. Now that is determined on multiple situations. Cases where cost of equity is lower, cost of debt is lower, cost of equity debt is significantly lower, cost of equity is slightly higher. So what are the the independent variables? How are they behaving? For your output may be similar, but how the independent variables are behaving, that gives you a clue into how you have modeled. So that's one. Second, is it linked to the reality? So you do a two-level kind of a check, right? So in your model is further enhanced basis this understanding, right? The other part which Kashish talked about here is while defining the inputs itself, there is a certain way in which you define input. For instance, the interest rates, cost of capital. How would you define the cost of capital, as a probability function? Is it a normal function? That's one level of assumption. What is the mean? That's second level of assumption. What is the standard deviation? That's third level of assumption, right? How do you check for that? You basically go back and see historical data. Maybe say a Nifty return pattern or a Sensex return pattern, right? For debt, you could look at, say, how say an SBI rate has looked at. Now, those are detailed studies which are to be done. In India, sometimes we don't look at it. Why? Because there is a sufficient. We are not doing a pure project finance kind of thing, but this situation is evolving. Like for instance, when you are doing things like say InvIT or the investment trust and so on. Those investment trusts have backers who are basically do not have significant balance sheet strength by their own. The asset is defined. I mean, the strength is defined by the asset they own, and in such cases, the standard assurances which bankers have, which investors have, are not available, and therefore you need to look at the asset itself. Another method where it could be used, for instance, is with infrastructure financing. There's often a refinancing used, which is called as the securitization of receivables, right? Which is used in highways, for instance, which has been used in highways, for instance. So now to understand the probability risk, because what you'll do is, basis this, you'll convert it into security, sell it in the market. And you need to kind of look at different aspects of this. So this is where your Monte Carlo can come in. Most uh, uh, project finance models would not do assessments on Monte Carlo using Monte Carlo or other methods of simulation, but it's a good technique for you to apply that and use it. It's something which can be useful in terms of generating different, wide, better understanding. Second, you can have better risk appreciation and therefore better structuring of the project. Okay, so that's the overall from the Monte Carlo thing. Then we now shift to financial analysis. So in the meantime, if there are any questions, let's have them. Any questions from anybody? So before we get on to the example and walk through the the steps, let's have a broader idea of what we're talking about in terms of financial analysis, right? And the bigger idea of financial analysis. So Aditya, if you could go to the next slide, please. So when we talk about financial analysis, there are two things we talk about, right? One, we say it's a review and analysis of a company's financial health, so number crunching of some form on the financial numbers of the company, right? To do what? To develop the understanding. So, right? So, to develop a better understanding of the company, right? But is this the objective of financial analysis? There is a higher level and a more core objective of the financial analysis. Ultimately, you have to take some decision. Remember, whatever you're doing in this world of finance has to do with money. Somebody is investing money, somebody is expecting money, somebody is, at a high risk of losing money as well. And if you are at the wrong level as an investor or an advisor, the blame or the credit will go to you. So, basis this financial analysis, you are doing what? Develop insight. But developing insight is also not the ultimate objective. It needs to be useful for your decision making. So you need to identify the drivers. You need to have the, check if it's relevant to your case and assess their impact. Doing financial analysis, the pure technique is not very difficult. Developing insights, making it useful for decision making is where a lot of effort goes into, right? So let's go to how the approach is. One, like, it's similar to in a way, it's not very different from how you do a financial model analysis as well. Say, know the business, right? Source the data, where do you get the data, which is basically financial statements, annual reports, etc., etc. Also, other data. Look at qualitative aspects as well, descriptions of data, backend data of how things have happened, etc., etc., why things have happened. A third and an important point, people who have done CA articleship would understand that there is a lot of effort which goes into developing and coming out with these financial statements. We give a glance of the financial statement and come to a quick conclusion. But there's a lot of things unsaid and layered within the financial statements. So spend time reading the financial statements. Don't treat financial analysis as an Excel exercise, is my earnest suggestion. It's beyond the Excel exercise. It's not just number crunch. And this is where, when you read it, you get the understanding of the business, right? You understand what is the business, which you would have understood it, but how is the business moving? Which driver is moving it more? How have drivers changed? Right? What has been the impact? What is the plan? What is the outcome? Right? So those are the things, and why, and in order to do what? To develop insights, as we talked earlier, about the key drivers, key factors, key dynamics, etc. Factors to consider in the analysis: understand your perspective. And this is an important point to understand. When you come as a promoter, when you come as an analyst, when you come as an institutional shareholder, your perspective is different. A promoter will look at, okay, a traditional Indian promoter says, okay, how much cash I'm ultimately making. They are very cash oriented in that sense. A private equity investor would probably say, okay, let me look at the IRR, okay, and then they would look at structuring or increasing debt levels to increase that IRR, because they are raising funds on the IRR and selling funds on the IRR basis, right? Your existing shareholders, if you're holding a share, you'll say, okay, Financial's performance is fine. How is it correlated with the pricing, etc., right? As a banker, you'll say serviceability is important to me, so let me look at that aspect. How to read the financial statement. Now, this is one method which Aditya will take you in with an example, but just to remember this, in terms of how you look at the flow, say level trend comparison. That's a technique. So the first step is look at the level. Take one statement. By statement, I mean what? P&L, cash flow, balance sheet. Take one statement. Take one base year. Identify key parameters. In P&L, you'll have your top line, EBITDA, bottom line, which is net PAT. In balance sheets, you'll have the sum of sub key items: total shareholders fund, long-term liability, short-term liability, total fixed assets, total non-current, other non-current assets, total current assets, cash reserve. So those are the key items, right? You go from your understanding of the business, and then you look at the composition. What is the breakup of that asset, right? What is the breakup of the revenue? What is the breakup of the operating cost? What is the breakup of the margin? And so on. So you're going from one point and you're spreading across. Why is that important? Because when you're dealing with data, when you see a financial analysis, you'll see like a swathe of numbers, a whole lot of numbers coming in, and it's easy to drown in those numbers and make it inefficient. So pick one point, pick a reference point, and then go further. Then do a trend analysis. Once you have captured the level for 1 year, do the trend analysis, which is basically year-on-year comparison across parameters, and then do a comparison across peers. This will give you a good perspective. When you are looking at the number, look at it actively. How you're doing it, you are defining what you're saying. Is it a defining number? Is it a key driver? How important is it? If it's important, it's a key driver. It's not important, it's not a key driver. Is everything important? Nothing is important. So what is more important? That you have to identify. Why so? That is something which you have to understand. Okay. Sometimes in certain cases, revenue might be defined. In a monopoly situation, like a saturated market, like utility, for instance, it's defined. In a case, for instance, highways which are running packed, your functions are defined. So those situations are there, right? So you are trying to understand why. What are the components? Is it normal? Is it for this particular year? Like if you see the financial statements of previous years, there has been the last 3 to 4 years like a lot of variation impact due to COVID, right? So there's an exceptionality which you would be seeing, which will normalize, has normalized significantly, will normalize more over a period of time. A key question to ask is it sustainable for future or right? So remember factors to consider, approach, process, and now Aditya will take you through the particular example. Over to you, Aditya.
Yeah, so the example that we're going to be using, the company that we're going to be doing financial analysis on today is JSW Infrastructure. So I'll just give you a brief about the company. So JSW Infrastructure Limited, it is part of the JSW Group. This company was established in 2006 and it is headquartered in Mumbai. It is engaged in developing and operating ports and logistics assets with a focus on handling multi-cargo operations. Its network is spread across both the west and east coast of India. On the west, it operates on ports at Jaigarh, Dharamtar, and Goa, while on the east, it operates at Paradeep and Ennore. So together, these facilities, they provide an installed capacity of around 177 million tons per annum as of financial year 24. And overall, JSW Infrastructure, it is positioned as a multi-cargo port operator with a geographically spread network and a combination of both group-linked and external cargo supported by integrated logistics connectivity. So I'll take you through their business overview as well. So their core operations, they provide port and port related services across a variety of cargo categories. This includes bulk cargo, break bulk, liquid cargo, and containers. So these services, they are supported not just by the basic port handling, but also by marine services, storage, evacuation, and last mile logistics. Then the commodities handled. So in terms of commodities, the business manages a wide mix. Major categories include coal, iron, ore, limestone, steel products, crude oil, petroleum products, LNG, and LPG. So this range ensures exposure to both industrial raw material as well as finished products. And from an analytical point of view, such diversity helps spread risk across multiple cargo segments, though dependency level on specific commodities like coal and iron ore are usually worth tracking when assessing the performance. Now the revenue mix direction. So on revenue, a large portion still comes from the anchor volumes linked to the JSW Group's business. However, over time, the company has been increasing its third-party cargo share. And their strengths finally is that in terms of positioning, few of their operational strengths, they stand out. So the company has a presence on both the west and east coast of India, which diversifies their geographical risk, and long-term contracts with their anchor customers, including the JSW Group, provide cargo visibility. Additionally, integrated evacuation infrastructure through road, rail, pipelines, and container freight stations or inland container depots, they also help in reducing their turnaround time and improve operational efficiency.